This was great. Brooks Sutherland there of Bloomberg Opinion. TK, the spotlight on Boeing.
Maybe there's a general in a hospital in Washington that can find something to do as he exits the fence and take Lloyd Austin out there to straighten out Boeing. I'm just coming up with an idea.
I'm not going there. I'm not going there.
I'm coming up with an idea.
I keep going back to what I've said in the last 24 hours. I think we all wish him a speedy recovery. It's not said enough.
Yes.
It's just the problem is we don't know what the recovery is from still. Coming up next on this program, Emily Rowland of John Hancock Investment Management from New York City with equity futures at session lows. We're down about 0.5%. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The market's probably a little bit overdone or was overdone into the end of the year.
People dashed into this market. They extended the expectations of rate cuts.
Whether the Fed cuts with March or May probably is not that much of a big deal. It's that the Fed that is going to cut this year. I think that's what's important.
The idea that the market's got 5 rate cuts priced in, 6 last week, 5 now, that might be wildly optimistic.
I think there are a number of things that could come in and trip this market up a bit, but usually it's something the market doesn't see coming.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P. Session lows down 0.5% on the S&P 500. TK following a pretty decent day of gains in yesterday's session.
A lot of distractions so far this morning. Boeing and the rest. I thought Brooks Sutherland there was just absolutely outstanding on the challenges for the nation and for Boeing in that. But guess what? It's about the markets too, and we underplayed it in the last hour. The markets yesterday, John, there's only one word: extraordinary. I mean, there's just no other way to put it. It was a true surge, refuting a lot of the negativity of the first couple of days.
Well, decent bounce, decent rebound, led by tech and discretionary. On the discretionary side of things, a couple of retailers, Abercrombie, Lululemon, saying things were better in the fourth quarter, raising their outlook, Lisa. Then Nvidia just has to come out and say new products, and then we get a big rally.
And the shares are up more than 6% on the day, leading this charge. To me, it just sort of speaks to the fact that everyone's looking for a reason to buy, and that any dip is buyable. Everyone's been saying it's going to be turbulent in the first couple of months or weeks or whatever, and then it's going to rally hard into the rest of the year. So you're basically seeing that. Yesterday, for example, UBS's David Lefkowitz came out, and he basically upgraded his outlook for the full year. So again, it's like even if there's going to be a sell-off,
a week into the year.
Exactly. All of the upgrades are kind of coming out. We got from Lori Calvasina, basically bringing forward a little bit of
from Goldman before the year was out.
Exactly.
Yeah, Costin, I thought, was really good.
Yeah, about that forecast for next year. Yeah, we'll pump that one up again.
But this is important. What Lisa's talking about, folks, is not one or two opinions. I'm going to say it's almost consensus that consensus is wrong.
Well, what is consensus at this point? If the
single digit,
a little bit over
middle single digit is a general statement.
My point is, when you take a step back, people don't see any reason for the rally that we saw at the end of last year to stop. If there isn't going to be some massive recession, if the Fed's going to be cutting rates, isn't it time to party? And the only thing that's making people nervous, including the Federal Reserve, is that maybe things are getting too easy with conditions. But that's the reason why people are ready to come back in the second that they get the all-clear signal.
How can you have too easy if you've got under 2% GDP, perhaps, or even 2.x% GDP? But to your point, we're not in recession. Tony Dwyer, among others, saying that's an important litmus test.
Let's just frame the year-end forecast: the high 5,200, the low 4,200. It's still a 1,000-point spread between the likes of JP Morgan and people over at Oppenheimer. It's a massive spread. Let's get to the price action. The scores right now on the S&P 500. Lots to look forward to. Lisa will give you the day ahead in just a moment. We've got CPI on Thursday, bank earnings from JP Morgan and Bank of America on Friday, then a ton of banks the following week as well. Equity futures on the S&P, session lows down about 0.5% on the S&P 500. Energy names struggled yesterday. Crude's bouncing back this morning, up by 2.3% here, Lisa, 72.42.
And oil's an important one to watch. The geopolitics of the moment could be the surprise that a lot of people are looking for to disrupt at least the normal that people are looking at right now. Today, Secretary of State Antony Blinken is continuing his tour in the Middle East, his fourth to the region since October 7th. He's in Tel Aviv today after visiting Turkey, Qatar, the United Arab Emirates, and Jordan. Key question around what potential escalations there are after the attacks, the latest ones by Israel on Hezbollah in southern Lebanon. 12 p.m. we hear from Fed Vice Chair for Supervision Michael Barr talking about bank regulation. I do want to hear what the evolution of this BTP kind of program is. What is it, BTFP? The sort of short-term funding that allows banks to not have to sell treasuries at a loss, that's really helped keep up the banking system. Do they continue that? I mean, that's a serious concern.
What happens if they don't?
Exactly. That's my point. I mean, does that sort of continue some of the disruption that we saw earlier this year?
You need a pretty epic treasury market rally to allay some concerns around that, don't you?
Which is the reason why I'm watching the auctions. 1 p.m., the most important moment of the day. Treasury is planning to sell $52 billion of 3-year notes. We get 10-year notes tomorrow, 30-year notes the following day. How much appetite is there at this point, especially given what we saw yesterday with inflation expectations for the next 3 years falling to the lowest since the pandemic started?
Busy couple of days coming up. Lisa, thanks for that. Let's kick off this hour's conversation with Emily Rowland, co-chief investment strategist at John Hancock Investment Management. Emily, great to catch up with you. In the last hour on Bloomberg TV, we spoke to Ben Laidler of eToro, who referred to tech names as teddy bear stocks. You hug them, they help you sleep at night, they deliver decent gains, at least for him, because he was long tech through most of last year. Emily, do you still like those so-called teddy bear stocks?
Yeah, we were long tech last year as well, really as a function of our preference for quality. So we were looking for companies with great balance sheets, tons of cash, low interest burdens, and we still like tech stocks, but we've got to recognize the fact that the S&P 500 growth index is now trading at a 44% premium to its 20-year average. So tech stocks were up about 58% last year on about 5% earnings growth. Now, don't get me wrong, 5% earnings growth was of the best globally in the U.S. tech sector, but I think it makes sense for tech to potentially take a bit of a breather here. We're not downgrading it, but I don't know how much you can expect this year after such an extraordinary 2023.
What are you doing on 60-40? I mean, to me, this is a really important question. I've seen huge failure of some of the marketing concepts like target benefit programs and all the rest of it. To get to an asset allocation, what do you do 60-40 forward?
I mean, what an incredible year in 2023 for a 60-40 portfolio after a horrible 2022. It was up about 18% last year. You know, when we look at it, and everybody was calling for it to be dead, right? The death of the 60-40 portfolio, clearly very much alive and well. When we look at it, we're modestly adding to our positions in fixed income. And to us, it's a math game. You know, you look on the stock side of the house, it's, you know, you're sitting at 19.5 times forward earnings. You've got 12% earnings growth penciled in by analysts on the street. It's just a tough starting point. We're not saying equities will do horrible this year. It's just the bar is really high. And when you look at fixed income, you know, 4 or 5% on high quality bonds, of course, there was a better entry point back in October, but we still look at the income on high quality bonds as a great way to sit here, get paid to wait, as we might experience some more volatility as the lagged impact of Fed tightening does cause cracks to form in the economic picture and in the labor market.
Is there such a thing as growthy value? I mean, I know you're going to tell me there's a partition between value and growth, but if I'm upset with 30 multiples or 22 multiples, where's that growthy value where at least I can hide?
Yeah, absolutely. So when we look on the value side, you've got to be really discerning because there's a lot of cyclicality inherently in value indices. So we're looking at areas that have a high quality element to them. So healthcare, for example, one of our favorite sectors. I know a lot of people have been coming on here talking about healthcare. It's trading at a 10% discount to the broad market. We think it's going to benefit as consumer behavior shifts. Maybe we're not going to buy all the stuff we want. I know we were talking about athleisure earlier. By the way, I have an 11-year-old daughter. I'm here to tell you athleisure is alive and well. But people are still going to do the things they need to do. They're going to go to the doctor. They're going to get medical care. Utilities, another area that got really, really hurt down, you know, last year. Everybody left it for dead. It's trading at a 20% discount. So we could see a rotation into those sort of dogs of the Dow as potentially tech takes a breather into 2024.
Emily, one thing I've really been struggling with in 2024 is what is the biggest risk? Is it a reacceleration of inflation or is it recession?
That's the question of the year, I think. And, you know, I think as you're looking at looser financial conditions, this is going to be one for the history books, right? Was the Fed too dovish over the last two meetings, suggesting that cuts are coming in the summary of economic projections? Markets are pricing in 5, 6 rate cuts this year. And of course, that's caused the loosening in financial conditions, which has been really spurring this pivot party that we've been talking about on the show this year. Right now, the pivot party's feeling a little bit like maybe a hangover. Maybe we're like trying out dry January here or something, as the markets are now back to this good news on the economic front, which is causing yields to back up, being sort of bad news on the equity front. So as far as recession goes, I think everybody's sort of tired of talking about it. And frankly, Matt Miskin and I don't really get paid on our views on whether recession plays out or not. We get paid on how we think about positioning into this environment. So maybe if it could, you know, we're prepared if an economic contraction takes place, again, leaning into high quality bonds, looking at income, and then rotating into these more defensive parts of the market that should benefit on a relative basis if something breaks, and we do see that contraction play out.
I guess that the way this folds into positioning is leaning into high quality income producing fixed income. Does this really get upended if the economy is hotter than expected and if the pivot party, as you pointed out, has just run way too far?
Yeah, I mean, there is a potential here, you know, certainly for rates to chop around. We're watching energy prices closely, which could play into the inflation picture here. Of course, the data on Thursday on CPI is going to be, critically important here. So there is a risk here that we see a reacceleration. It's just hard to imagine an environment where inflation goes back to the 9% that we saw in the summer of 2022. Obviously, there were some very unique sort of pandemic era dynamics there around supply chains, around fiscal stimulus. So we think that ultimately we go back to a low growth, low inflation, low rate environment, which really permeated the markets and the economy for much of the last decade. Nothing changed except we pumped $5 trillion of stimulus into the U.S. economy. There's forces out there that are very much disinflationary, and we think over the longer term, that's where we go. And we're headed in that direction, certainly, as we start the year.
Emily, I mentioned Ben Lade there, and he talked about the opportunities in Europe. Is the bias still America, U.S. stocks?
It is. I mean, you guys have been talking a lot this morning about how horrible, for lack of a better word, the data is coming out of Europe and certainly in Germany. And it's interesting to see, stocks really not reacting to that in Europe. There's been buoyancy, there's been participation. The weaker dollar has helped non-U.S. equities. But when we look to the U.S., we're holding up the best around the world economically. Our labor market is undoubtedly the strongest across the world, and earnings estimates here are more robust than they are in other areas. And then finally, we just have more high-quality stocks here in the U.S. So we do still have a preference for U.S. equities over international, especially over emerging market equities, where we think China is going to be challenged into this year.
Interesting. Emily, thank you. Emily Rowland there of John Hancock Investment Management. Almost the total opposite of what we heard from Sharon Bell at Goldman Sachs yesterday, Lisa, who was much more constructive on Europe and much more constructive about the global growth backdrop as well.
This has to go to really what's being priced in, and also your view on China at a time where that really has been the slowdown that everyone knows about. And again, this goes to, okay, have we really understood the ramifications of that? And has that reached a trough, given that they're likely to inject some stimulus?
The smartest thing I've heard in this in the last 12 months, 18 months, is a guy named Scott Galloway at New York University, who's pretty good at thinking about this. And he extends the time frame, John, these cycles, these moods, China this, China that. Guess what? The optimism on tech, it's a 3, 5, 10-year phenomenon to Professor Galloway.
Particularly around AI for so many people out there as well. If you are just joining us, welcome to the program on the S&P 500. We are negative here by 0.4%, following a really, really decent day of gains on the S&P 500. Before that, last week was pretty rough. First weekly loss going back to October. People like Bramo talking about sober January in the equity market, Lisa.
Oh, yeah. Well, we just heard the same thing from Emily Rowland.
That's why I mentioned it.
Dry
January. Yes.
Yeah, just building on this feeling that we're all just depriving ourselves of the joy that we felt at the end of last year.
In stocks running up and rallying. It felt good for you, didn't it?
Well, sort of.
I was just giving you your props.
Thank you. I think
anytime I'm looking out for you.
That's really sweet.
Bramo branded January in like the first 2 days of the month after a couple of days of losses, TK.
I didn't notice.
You were talking to me. He's like, why are people hysterical? It's just notable because at least there were declines. I mean, the fact that it was the biggest weekly decline going back to October tells you first weekly decline since October.
It tells you more about the gains than the sell-off.
Exactly.
We're totally on the same page. Darryl Cronk of Wells Fargo in the next hour on Bloomberg TV and radio to break down this equity market for you. With us around the table in just a moment, Bloomberg's Anne-Marie, up from Washington, D.C., here in New York City, to try and help us find the Defense Secretary, Lloyd Austin. Her thoughts on that coming up next from New York, equity futures, session lows. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 100 moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Daybreak Europe. I'm Kriti Gupta. And let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The 2024 nominating contests are here, and the candidates are making their cases to voters in Iowa ahead of the caucuses. Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
And at the end of the day, that's what the American people want.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
It all starts Monday in Iowa, only on Bloomberg. Context changes everything.
I understand their passion, and I've been quietly working with the Israeli government to get them to reduce and significantly get out of Gaza. I'm using all that I can to do.
Quite a scene. President Biden addressing the situation in Gaza after facing interruptions from pro-Palestine protesters during a speech in Charleston. More with Anne-Marie around the table here in New York in just a moment. I want to touch base on a price action. Equity futures on the S&P 500 negative here by 0.4% on the S&P. Really decent day of gains yesterday on both the S&P and the Nasdaq. The best day of gains going back to the middle of November. There's some data this week we can talk about. CPI inflation data on Thursday. Some earnings to talk about as well. You'll get numbers from JP Morgan, Bank of America on Friday. Then all the other banks, TK, to kick off next week.
It's going to be interesting to say the least. A deserved vacation for Emery Horton, our Bloomberg, Iowa, New Hampshire correspondent. You're getting ready for the festivities to begin. We're thrilled that she's back with us. Emery, I'm going to cut to the chase and just say there's so many different stories, but this war or that war or both wars just won't go away for this president, will they?
They won't go away for this president, and we see this urgent trip from Secretary Blinken over to the region to try to quell some of these concerns. And you don't just see it on the international pages of the newspaper anymore. The president yesterday is in South Carolina trying to shore up a key voting bloc. We're seeing softer numbers in the polling when it comes to the Black American community, the African American community, and while he begins that speech talking about the threat of democracy, he's hit with protesters talking about Gaza and what is going on in Israel. So it's a huge concern for this administration. On top of that, as John mentioned before the break, what's going on is shining a lot of light on the foreign policy apparatus because there's a lot of questions remaining about what is going on with Lloyd Austin, his defense secretary.
Let's get into that. Who's running the Pentagon right now?
I think that would be his deputy at the moment. Well, technically he is. Brigadier General Pat Ryder came out and said he is now out of the ICU and he will be running it. But for 2 days, it was the deputy. And not everyone knew that. Only a small group of people within the Pentagon knew that until the chief of staff told the White House and told top members of Congress about Lloyd Austin's condition.
I think a lot of us find this absolutely unbelievable, astounding. Terry Haynes of Pangaea was on this program an hour ago, and he was basically calling for the resignation of the defense secretary, where I find things to be really, really confusing. And I'm wondering if any of your reporting can give us some color on this. When you have the kind of terrorist attack that we had last Wednesday in Iran, and the kind of questions that people were asking about the prospect of a broader war and things escalating in the Middle East, are we sitting here and concluding that the likes of Jake Sullivan, the National Security Advisor to the President, the White House, didn't speak to the Pentagon on Wednesday? And if they did, they weren't aware even then where the Defense Secretary was?
Well, there was a strike in Baghdad, and Brigadier General Pat Ryder said that that was a discussion Lloyd Austin had with the president before he went back to the hospital for this emergency and went into intensive care, was taken by an ambulance. But yes, for 48 hours, the question is, who were they speaking with?
there's real-time tracking of these people. They're supposed to be in the Situation Room. So there's a lot of questions regarding how this administration operates. There was a lot of questions after the fall of Kabul about intra-agency and communication within different agencies within the administration, which many believe led to the failure of that withdrawal of U.S. troops and personnel from Afghanistan. And it seems that potentially they didn't learn those lessons of intra-agency communications. A lot of criticism on this White House of how they're very insular within.
We need to understand a lot more what happened, and I'm sure that we will learn more in the days and weeks ahead, or I hope that we learn some more. In the meantime, there's also this question about Lloyd Austin being a very private man, and he was known in Washington, D.C. as trying to really keep a lot close to his chest. Is that sort of a theme throughout the Biden administration, that people who are in public positions that are setting policy and really, close to the presidency in line are private people that are not present enough in the public eye?
Well, when you get one of these jobs, you can kiss your private life goodbye. That just doesn't happen. Obviously, there's some things that are private, but going into the hospital, undergoing anesthesia. Again, we don't even know what this procedure he had done with. So I'm assuming he went under anesthesia. These are things that need to be communicated. And Lloyd Austin has said that. He's come out with a statement about this. But there's growing calls in Congress. You're talking about Terry Haynes. You should see what Republicans are putting out there. Elise Stefanik wants his resignation. Some are saying that there should be an impeachment for Lloyd Austin in Congress, but even Democrats are saying more needs to be done. I'm looking at Senator Reid, who's saying that there needs to be a full understanding and accountability of this.
Right. So if you take a step back, there's a question about whether they're going to find a fall guy within the Secretary of Defense or the Defense Department. And then there's a question of where the buck stops. Is this more a problem for the Defense Department or more a problem for the White House?
I think it's both. But at the end of the day, the buck stops with the president. Voters will be going to the poll this year, this November. If they don't like what they see, they're going to vote on it.
Jack Reed, you mentioned, of Rhode Island. This is not just another senator. Describe the importance of Senator Reed of Rhode Island to this debate over the general.
Well, he's chairman of the Senate Armed Services Committee. This is a Democrat.
But he served the nation in the military. He's not just a normal politician.
No, of course not. No, so he understands also what it means if you were what Republicans are calling this is a dereliction of duty. He understands what that truly means to someone who has served.
I mean, where does this go in the next 24 hours? I mean, and it's unfair to ask you this, but to me, it's just extraordinary.
The questions are not going to stop, especially as we see Congress come back and go into full session. And it's going to be an easy point for members of Congress to deflect when they don't want to answer questions about how they're going to continue funding the government and whether or not they're going to get a broader deal on national security concerns and the border deal. They're going to, especially Republicans, are going to want to easily reflect on this.
Let's finish where we started. The President of the United States. It's an unpopular war between Israel and Hamas. At the beginning of that war, the president stood shoulder to shoulder with Israeli leadership and clearly has suffered in the polls as a consequence. How is he going to address that in the coming months? You've seen a change of approach from this administration off the back of those moves in the polls.
You're not going to see that bear hug happen ever again. And this is what the president said yesterday to the protesters. I understand the passion. I've been quietly working with the Israeli government to reduce significantly and get out of Gaza. So all of these conversations that we have been talking about that are quote unquote private between the White House and Netanyahu, I think a lot more details of those are going to become public.
MH, great to have you with us here in New York City. Anne-Marie Horton there, weighing in on the latest, Tom, down in Washington. A delicate time for the President of the United States.
Oh, beyond delicate.
A lot of work to do this year, that's for sure.
I can't emphasize enough the Democratic response to this, John. This is not about Republicans going after the Democrats' usual thing. This is a bipartisan, nuanced outrage.
But there's also a real question about Democratic support for President Biden right now. And we keep talking about it, and everyone within the White House keeps saying, stop talking about it, because we're not talking about it. And yet it's going to really become something serious heading into November, given some of these polls and given where we are.
I've really struggled with the communication of this White House, haven't you? Over the last couple of years, there's occasions like these that are just absolutely bizarre.
And we're not getting a sense of the play-by-play, and we're not getting a sense of someone coming out and saying, look, this is completely unacceptable. We're going to have this kind of inquiry. We're going to give you these details at this time, and, you know, we're not going to let this happen again.
We're not the last administration, seems to be the approach of this administration, Tom. So you should be happy. That's the way they behave.
That was the initial
model.
That's
the way they behave.
Okay, that was the initial model.
We're not them, so you should be satisfied, which means we have a different set of standards. It's just kind of like,
that was the first 100 days.
You're in the White House now, and this is what we expect. expect? It's kind of weird.
First 50 days, first 100 days. I mean, if the Conservatives were thrown out in England and the Labour took over, they'd have their first 100 days. Same kind of equivalency.
Sure.
And then you got to be yourself.
I have to say, one thing that I keep hearing on the margins with people in the market is that political crisis is becoming more and more in their focus in terms of a potential risk for 2024. And I always say, yeah, that's what everyone always says, and then nothing ever happens. But this time feels a little different based on what we are setting up for.
Coming up on this market, Guy Lebas of Jenny Montgomery Scott on fixed income. That conversation coming up shortly. And fixed income right now, just a quick check of the bond market for you. Yields higher by a single basis point. The 10-year 4.04%. The 2-year basically unchanged at 4.38. In the equity market on the S&P 500, just a little bounce, a small bounce off session lows. We're negative here by 0.4%. From New York City, this is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Big bounce yesterday, fading just a little bit this morning. Good morning to you. On the S&P 500, negative, just off session lows. We're down on the S&P by 0.4%, down by 0.6 on the Nasdaq 100. On the Russell, the small caps down by a little more than 1%. Had a decent slate of earnings in the past 24 hours. Heard from a few retailers, Lulu, Abercrombie, things better. Heard from one financial services firm, Jeffrey. things not great. And Lisa, that tees up earnings this coming Friday.
Especially because Jefferies usually is the first. We do get JP Morgan and Bank of America on Friday. But Jefferies posted a 53 jump to their earnings for the fourth quarter based on a year earlier. That is dismal. They were saying, well, you know, it's just a trough year and we're going to see things get better. They got to get better. Question is how much and whether that's really being priced in.
We'll dig into those numbers in just a moment. Let's turn to the bond market, the 2-year, the 10-year, the 30-year, going into CPI in a couple of days' time. CPI Thursday, Tom, PPI Friday. Yields back above 4% in the last few sessions. We're just about holding on, 4.04% on a 10-year.
It's going to be interesting to see what CPI is. There's cross currents. If you look at ECO Go, one series is sort of flat to up, another series is flat to down. I'm going to go back to Carl Weinberg publishing this morning. Granted, it's on Europe and not in the United States, but the look back 12 months screws up the math. It's such a shock from where we were 12 months ago.
Let's go back to
it's got to be an
Jane
asterisk.
Foley of Rabobank, and we can talk about Europe. Bring up the euro. Jane Foley of Rabobank on this program in the last hour. TK basically saying Europe needs a weaker euro, given what's happening in Germany at the moment. Europe needs one.
Well, and we're going to have to see. And again, you may see this at Davos. Carl saying that Lagarde will make an appearance, as she always does. And you know what? Where else are you going to make a statement like, I'm done? You know, let's go.
The sort of confusion of this year is really summed up by Sharon Bell and Jane Foley. Sharon Bell saying that actually a stronger euro is usually associated with better growth because it signifies a better backdrop. And then you have Jane Foley saying for an export perspective, you need a weaker euro. There is no agreement on the market response to any geopolitical or sort of macro trend, and that, I think, continues into 2024.
That's the story for the euro, 109.35. Lisa framing things nicely for you. Let's get you some top stories under surveillance this morning. United Airlines and Alaska Air finding loose bolts similar to those thought to be behind Friday's blowout on a Boeing 737 MAX 9 jet. The carrier saying the issues were found during their own maintenance checks. All MAX 9 jets have been grounded for the time being. Boeing has since issued guidance on what inspections are needed to prevent another accident. Yesterday, the stock was down 8%. Muted price action this morning, but I think we all said it a little bit earlier. The more you hear, the worse it sounds.
And bigger questions about Spiro Aerosystems and exactly who is responsible. Is it Boeing to be really overseeing some of the quality control, but also who's inspecting this stuff for the FAA? You brought this up earlier, and I was looking at the salary for FAA employees, and I'm wondering, at $100,000 on average, is that not enough to really attract people to stay there for long enough to actually make sure we're in a good place?
We had a tour de force from Brooke Sutherland of Bloomberg Opinion, folks, and I would, forget about what she's talking to us way too early in the morning for her. But it's going to be fascinating to see what Brooke Sutherland writes in the next couple days about what the what the to-do is for this huge national problem.
Agreed. More from the team here at Bloomberg through the day on Bloomberg TV and radio. Let's get to this story. Bill Gross saying 10-year treasuries are overvalued at 4%. The PIMCO co-founder going on to post on X the following: 10-year treasury inflation-protected securities at 1.8% is the better choice if you need to buy bonds. I don't. He made millions late last year after betting the Fed would pivot to cuts this year and warning the bond market was misguided in August. Another about turn, Lisa, from the former bond king.
Okay, so here's my question. Is this just going to be sort of the nuance, the sort of trading of the range, or is this some kind of big, bold call? Essentially, people are just saying trade the range because there's nothing exciting that's going to happen in the near term because we just don't know yet because of the economic data.
Dovetail it with Jim Bianco yesterday, looking for price down and yield up as well. And there's a heated battle out there. And on the other side, I mentioned this early in the morning, Priya Misra, with a 10-year inflation-adjusted yield, as Mr. Gross mentions tips, of, I'm going to call it 1.XX%, but I believe Misra of JP Morgan was talking about a real yield going from a 180 in the vicinity of 1.00 away from the gross call.
Priya mentioning that once you get a 4% on the nominal yield, you start to see buying coming. She was saying that just last week. 10-year, 4%, that's a buy.
Battle.
A lot of people think that that's a buy. Right now, 4.04%. I want to get to the earnings. We mentioned them briefly. The numbers from Jefferies reporting a fourth quarter drop in profit as the deal slump on Wall Street continues. The bank's parent company posting earnings of $66 million. That's down from $140 a year earlier. Results also weighed down by a 64% drop in asset management and declining advisory fees. Wall Street's biggest banks set to report on Friday with JP Morgan, Citi, Wells Fargo, and Bank of America on deck. Not a great start start, Lisa, for the financials?
So I dug up some numbers, and Bain put this out, that global M&A was on track in 2023 to fall about 20%. If you take a look at just private equity and venture capital, it was down some near 40% year on year. So this is the kind of comps that you're looking at that probably did, I don't know, at least punch a hole in some of the bank's earnings.
Let's get to a fixed income debate and continue the conversation forward. Guy Labaz joins right now, Chief Fixed Income Strategist, Janney Montgomery Scott, Philadelphia. Guy, thank you so much for joining this morning. Just simple, let's begin with a call. Yields lower or higher this year?
Marginally higher in the short term. But I think the broader theme we're seeing right now is there's some structural changes in the market led by larger treasury markets, more power from trend following CTAs to influence the level of interest rates. And so we're likely to see periods of, call it 4 to 8 weeks of consistently trending interest rates. And we expect over the next 4 to 8 weeks, those consistently trending interest rates are towards the high side.
Do you clip a coupon this year? Or like last year, there were some real pockets of total return out there in fixed income. Can you redo that this year?
It's going to be a lot harder. As we went into 2023 last year, credit spreads were relatively wide. We were still sort of reeling from the late year risk-off theme across a range of markets. But right now, as we sit at the beginning of 2024, the reality is that credit spreads are really near their recent heights. Investment grade spreads are just a hair above 100 basis points. High yield spreads are inside of 350 basis points. And so it's really hard to generate big excess returns in that world. We think it's going to be more about surfing those waves of trending interest rates, again, sort of in a 4 to 8 week period throughout the year, as CTAs, those momentum-based traders, go all in long and all in short, respectively.
This is what we keep hearing from a lot of people, Guy, that this is sort of a trade the range kind of year. What does that mean in terms of volatility? Does it mean that it's actually less volatile because people are looking to just come in and take the other side when things start moving too far in one direction?
Yeah, we consider volatility predominantly a feature of the uncertainty of the policy landscape, and the Fed policy landscape is becoming a lot more clear. Again, to recall where we were about this time last year, we were uncertain as an investment society whether we were looking at further 50 basis points, 75 basis point, or even something else, clips of Fed rate hikes. Right now, that theme is a lot calmer, and so I don't suspect that short-term volatility is going to be all that prominent an issue. I would also say that over time, as the CTA momentum-type trader investors become sort of chopped up, we're expecting kind of disappointing returns from that sector in 2024. They'll also start to see capital pull back, and they'll become less of a force in markets as the year progresses. But right now, it's definitely that trade the trend, I should say, rather than the range.
Guy, what do you think is the biggest risk for 2024? The risk of recession or the risk of reaccelerating inflation?
Well, I would argue right now it's certainly re-accelerating inflation. This, of course, comes 2 days before the first CPI release of this year, referring to December. We have a really big expectation as an investing society of moderate inflation. And as we've seen in the last year or so, there can be a lot of surprises just brought about by noisy data. The fact that we're measuring inflation once a month when inflation is really a process that takes place over time. And that could prove enough to spook markets, even though it's not really all that meaningful in the intermediate term.
But good guy, over 3 years, we have had a brutal bond market. Price down, yield up is a generalization. We've made some recovery, I get that. Are Janney Montgomery Scott bond clients healed from that debacle, or are they still living it?
Yeah, that's a really good question, Tom. What I'll say is that our clients, quite independent from the advice we offer, they tend to shade right now towards shorter term bonds. And that could include things as short as money market funds. So I think the reason is not just the experience of the last few years, 2022 in particular, in which we saw double-digit drops in market values, but it's also relative yields, right? The front end of the yield curve still, if you just measure today's yield, offers a lot more carry than going out to the 7 to 10 year portion of the yield curve, about 125, 150 basis points more carry.
Who's going to destabilize this on issuance? Is it going to be corporate issuance that makes things uncertain, or can it be Yellen and what she may do with government paper that Lisa talks about so often?
Yeah, we're not looking for a huge slug of corporate issuance in 2024. Of course, we're saying this right the week when bank earnings come out and corporate issuance starts to really ramp up for the year. And in addition, when you look at the Treasury's issuance plans, they've really ramped up the portion of bill issuance. And I think that kind of does a little bit of a limit to the supply concerns that were so prominent in the August through October timeframe. So I really doubt we're going to get a big increase in longer term issuance supply. It's going to be more about bills in the front end. I'm not hugely concerned about supply as a big theme this year, more focused on CTA positioning, as we talked about in the first couple of moments of the segment, as a really determinant of the level of interest rates in the short term.
We're always talking about that moment of reckoning for the budget deficit. It's a conversation we've been having for a long, long time. Michael Semblist, the brilliant Michael Semblist over at JP Morgan, wrote about the boiling of the frog, that at some point between now and 2030, we've got to have that day of reckoning. My words, not his. He talks about the CBO projections that by early 2030, all federal government revenues will be consumed by entitlement payments and interest on the federal debt. Guy, do you see that day of reckoning on the horizon anytime soon?
Well, I'll say those comments or similar ones have been a feature of markets for as long as I have been involved in them. I don't have any detailed opinion on when that day of reckoning, to use your phrase, is likely to arrive. I'm not even confident it does. But I will say one thing: high levels of nominal GDP growth through something like a big boost in economic productivity, even through marginally higher inflation over the course of a 5 or 10 year period. I'm talking 50 basis points higher inflation, not percentage points higher inflation. Both of those things would do a great deal to reducing the size of the deficit, reducing the size of the treasury markets as a portion of the economy. Governments don't generally pay down debt. Over time, they usually inflate it away. And that strikes me as the most likely outcome over a 5 or a 10 or a 20-year period here.
Guy, appreciate your balanced view, as always. Thanks for joining us. Guy Debada of Jenny Montgomery Scott on this Treasury market. Lisa, we've been having that conversation for a long time.
This one analyst on Twitter, or X, put this out earlier this morning. The greatest trick the devil ever pulled was convincing people that government actually paid back their debts.
Basically what Guy just said, right?
It's essentially like, not going to happen. They're not going to pay it down. It's the whole inflating it away. And so at what point was the inflation of the post-pandemic era a gift to the United States, and how much was it offset by the amount of issuance that the U.S. did?
Well said, Bramo. If you are just joining us this morning, welcome to the program. The S&P 500 is negative by 0.4%. Yields are higher by a single basis point, 4.04% on a 10-year. Coming up a little bit later this morning, 8:30 Eastern Time, the brilliant Neil Dutta of Renaissance Macro, one of the best forecasters of this economy last year, Tom, for much of last year. And then later on this morning, the next segment actually, we'll catch up with Ian Bremmer of Eurasia Group on their top risk, Tom, for 2024.
What a gloomy set of top risks. Bremmer just outdoing himself this year with a real caution that's within the global system, the geopolitical system right now. It's not a normal top risks at all. On Neil Dutta, his chart's out there right now. Real wage growth is tangible. That's the core Neil Dutta chart.
That's the big call. Thinks it's supportive of discretionary spending. And Lisa, that was one of the leading sectors on the S&P 500 yesterday.
Given the fact that Lululemon really had their pop in sales, and we heard Emily Rowland there leaning into this whole idea. Okay, so what's the cutoff in terms of pricing, though, to buy stretch pants for your children? I am not sure. That's what I kept thinking about as you talked.
You've brought up Lulu, you've smiled. Well, how much money did you spend at Lulu?
You know, it's not that I don't want to disclose anything. I think that that's really private. And I think I'm.
Well, you're not giving it away at all.
No, but it's $130 dollars for a pair of stretch pants, and you have to wonder, if you've got like a 10-year-old who's going to grow out of them.
Oh right, yeah, that
really?
Sounds ridiculous.
But that's my point.
That sounds ridiculous.
That's what I'm saying.
No, I was thinking more about your sales.
No, I'm fine.
Did you go into the sales? Were the sales good at Lulu?
I didn't.
No, you didn't go. Okay.
I don't know.
Of course you didn't. All right, sure. All right. Lisa didn't go. Equity futures on the S&P 500 just slightly negative. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Our strong preference is that the Houthis get the message that they're receiving from countries around the world that this needs to stop, and that's what we're focused on. It's clearly not in the interest of anyone, Israel, Lebanon, Hezbollah, for that matter, to see this escalate and to see an actual conflict. And the Israelis have been very clear with us that they want to find a diplomatic way forward.
That was U.S. Secretary of State Antony Blinken addressing the situations in the Red Sea and the rising tensions in the Middle East, continuing his shuttle diplomacy trip in the region. Amazing to hear that, see what's taken place over the last 3-4 months, and then see this in the commodity market. Pull up the board and check out crude. WTI, Brent crude, still incredibly low given what's happening in the world at the moment, TK. WTI 72.48. Do you remember the calls for triple-digit crude by Halloween in September?
EM, up, and all that.
And arguably things got worse in the Middle East, not better. And yet here we are at 72.50. And arguably perhaps because production in America is north of 13 million barrels a day.
With our vast U.S. oil policy.
Phenomenal.
I would say Scotland has a better oil policy than we do, or at least they have one identifiable. John Farrow has made it clear we're stopped saying Happy New Year's. What day did we cut that off?
January 5th.
And today is January 9th, I believe. And what we know for certain is Ian Bremmer and all of Eurasia Group have to rewrite their top risk for 2024 on January 9th. That's how fast things are happening. He is here today with the top risk. What a grim set of risks in an election year. How uncertain is it to get to March or to get to, say, the middle of May?
Well, first of all, Happy New Year, Tom, and to all of you here at Bloomberg Surveillance. So nice to join you as we kick off 2024 on January 9th. No, I don't think we have to rewrite these risks, but I think we have to recognize just how incapable we, the United States, and our present set of global leaders are in trying to contain the geopolitical risks and conflicts that we face today. You just saw the entry we had Blinken standing there in the Middle East saying they need to understand. We need them to understand. The Houthis need to understand. They need to stop this. He could have easily said the Hamas needs to understand they have to let these hostages go. The Israeli War Cabinet needs to understand that they can't continue to expand the fighting in the region. The United States has zero ability to actually make those messages land with the actors on the ground who are escalating this conflict.
Triangulate this right now with Fareed Zakaria's essay in Foreign Affairs magazine in his post-American world and the Bremmer post-American world. You say the U.S. is battling itself. That sounds a lot like Zakaria 20 years ago. Triangulate right now the lack of confidence you have in our U.S. geopolitical strategy.
It was about 12 years ago when I first came up with this idea of a G0 world, where the United States was not going to be willing and able to be the global policeman, the architect of global trade, and the promoter of global values, but that no other country or group of countries would be able to step into its place. And that as that geopolitical recession played out, there would be more conflict. There would be more vacuums that would be filled by rogue actors who take advantage of the comparative chaos, of the lack of leadership. 12 years of that gets you much bigger and unmitigated fighting. We see that with Russia, Ukraine, started in 2014. Nobody really pushed back, and now we are here in 2024, and that war is turning trajectory in a way that none of us are comfortable with in the West. You see that in the Middle East, and that is set to expand significantly. And we see in the United States itself that we are increasingly a tribal, non-functional democracy in crisis. Very simple point. When you have the former Secretary of Defense under Trump saying this man is a threat to democracy, he was in charge of American national security under Trump. When you have the person who is running having tried to subvert a free and fair transfer of power, doing everything in his power to do so, in a functional democracy, that would be the #1 issue of the election. Nothing else would be close. So is it that we're somehow getting our facts wrong? Or is it that the United States is not a consolidated functional democracy? Because there ain't no other advanced industrial democracies. No one else in the G7 is having the problems in legitimacy of its political institutions that the United States is experiencing in 2024.
What do you think it is?
Those are ours. What do I think?
What do you think it is? Do you think it is a functioning democracy?
No, I think it's a hybrid system. I think the U.S. democratic institutions have significantly eroded over the course of the past several decades. We have normalized that because all of the things that are unprecedented as they happen, and we still live here in the United States, we're basically saying, well, okay, I guess that's the way it works now. So impeachment doesn't work, and we can impeach someone twice and they can still run again. I guess that's the way it works. You can have 91 indictments, and I guess that's the way it works. You can post and say things that you never would have heard. I guess that's the way it works. Now, as set against the context of the world's most powerful, very functional economy and the world's most functional, very powerful global defense capacity, you'd say, well, maybe it's okay that the United States isn't a functional democracy, but it will be different. And so, yeah, I think we can't normalize the dysfunction of the U.S. political system, the illegitimacy of its institutions, and the fact that democracy in 2024 in the United States is in crisis. That is the reality. And our allies know that. They're deeply worried about it, all of them around the world. And our adversaries see this as potentially a huge opportunity for themselves.
So where do you see us 12 months from now? What do things look like?
First of all, let's talk about March, April, May. Tom said you need to completely rewrite this then. When Trump gets the nomination, which is very, very likely, he will overnight become far more powerful on the U.S. and the global stage. All of the Republicans will be loyal to him in a way that right now they still have hedging capacity. And the media that is following and supporting Trump, and the ability to raise money to drive that campaign. And that means his policy pronouncements, like there would never be a war against Israel if I was president because I showed the Iranians, I announced that assassination of Qasem Soleimani. Well, that's going to be the policy for Trump and therefore the Republicans. Zelensky, corrupt. I'd end this war in a day. I'd show him what's what. I'm not going to give him billions and billions of dollars on the back of the American taxpayers. That becomes the policy. So the Overton window, right, of what is an acceptable policy frame debate in the United States is going to change very dramatically when Trump becomes the nominee. Again, assuming that. It's not given, but assuming that. And in 12 months' time, the stakes are a lot higher for both leaders than they ever have been before, right? So if Trump wins, Biden and many, many people around him believe that they will face legal jeopardy, that Trump will politicize the FBI, the DOJ, the IRS, and go after them in a McCarthyite, prioritization of policy, where Trump, of course, faces potential prison time. So the stakes are much, much higher than we saw in 2020.
Just quickly, Ian, is Biden the antidote to this at a time where there are real questions around the defense secretary and his absence, his undisclosed hospitalization, and the sense that President Biden is not very popular and isn't really addressing that?
I was a little surprised that we had no idea where the Secretary of Defense was for several days in the middle of a war. That usually happens in China. That doesn't happen in the United States. Yeah, I know. I discussed that with an official yesterday, and he kind of had a chuckle over it.
It's exactly what I said yesterday.
Yeah. Is it really? I missed that.
Was this the official you talked to yesterday?
Good man. No, this is a Chinese official, but it was pretty funny. We all had a good chuckle over it. It's not what you want to see. Look, I think that Biden has the intention of being the antidote. He wants to follow rule of law. But, I mean, we're in the 4th year of the Biden administration, and the reality is the country is more politically divided. Our institutions are weaker today than they were when Biden became president. So he does not have the ability to resolve the divisions in the United States. Look, you look at Russia and Ukraine today, and you'd say that Zelensky would like to end the war, but he doesn't have the ability to do that, right? And that's the problem. We have these major conflicts geopolitically between Russia, Ukraine, between Israel and Hamas, and between the United States and itself. And in none of these cases is diplomacy an option. And in none of these cases do the principals have the ability and the willingness to stop the fighting. That's what 2024 is. That is, when I look ahead in 12 months' time, that's where we are. That's what G0 means.
Always an interesting read. Thanks for joining us, sir. It's good to catch up. Ian Bremer there, of Eurasia Group. TK, the biggest risk is the United States itself. Oh, you won't come back now.
That's okay. I will. In February, I'm going to say Happy New Year.
I'll make sure you
Next week in Davos, I'll see you Happy New Year. That's what I'm going to keep doing.
I don't think you're with us in Davos. I'll make sure that's not the case.
Okay, that's fair enough.
From New York City, futures on the S&P, slightly negative. We're down 1/3 of 1%.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
What does it take to be a great surgeon?
This may sound trite. Perseverance, resilience, in practical terms, being able to take a blow and not having it become a permanent deformity, and grit.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We're past the peak in interest rates. Investors do not want to miss out this time.
I do think the Fed is a little frustrated by the fact the market always wants to be more dovish than the Fed wants.
The longer that gap increases between when the Fed should start to cut, how quickly they cut, I think the odds of a hard landing start to increase.
There is no soft landing in this economy right now. I mean, that's kind of wishful thinking.
The Fed is trying to do the impossible right now. My heart goes out to them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Bloomberg Surveillance. As we were coming on to air, Lisa Abramowitz on the phone with her broker, looking at Bitcoin in her retirement plan. Looks good. It's upon us. And wait, we're going to talk the markets here, John, and all that's going on in the surveillance world. And to me, it's one big distraction, except it's here. I mean, today, Eric Balchunas of Bloomberg
potentially here.
Saying potentially Bitcoin ETF is there. Gary Gensler out with an extended thread with all the risks involved. You put those risks overlaid on the risks in the market, it's a risky 2024.
Well, let's talk about financial markets of the last week or so. Lisa and I have been talking about this for a while, just the conflicting data, Tom. The conflicting economic data, the conflicting earnings stories as well. So you can identify a slowdown in ISM services. The number looks terrible on Friday. Maybe you're starting to worry about what's going to happen to the broader economy. And then companies like Lululemon come out, Abercrombie, and start upgrading their outlook off the back of that. Companies like NVIDIA release new products. The appetite for them, we're expecting it to be through the roof. The stocks start rallying. The equity market bounces back. It's kind of been the story of the last 12 months.
4, 5, 6 trading days here. Now, we could go back, we could go down 3 more days. You know, we could have another January 2, 3, 4 here, down. We go boom, up like yesterday. And it just shows the immense uncertainty out there overlaid on top of the Bitcoin advent that seems to be imminent.
I'd put it this way, Tom. Soft data versus hard data. Lots of people have reached out to me about that. The survey data is not fantastic, particularly manufacturing hasn't been for a long, long time. If you look at the hard data, though, things are okay. Jobless claims still around 200K. And if you had to pick out a single data point to understand the health of the labour market over the last 12 months, claims would probably be it.
Yeah, and Lisa, Michael Feroli at JP Morgan writing Friday, yes, the job report was actually everything considered constructive and optimistic, and yet half of America seems flat on her back, particularly when you look at our political debate.
What I find fascinating is we're at a moment where the market's moving faster than the Fed would like, and the Fed's trying to jawbone it back. And you saw this with Michelle Bowman, reiterating this concept that maybe because people are getting enthusiastic about bonds and stocks once again, that could actually force their hand and cause them to stay higher for longer. So I keep going back to this one main question, which is the bigger risk for this year? A recession or a reignition of inflation?
Right.
And that, to me, I don't think is quite clear.
All we can do is look at the data, John. I'm going to start with the 10-year inflation-adjusted yield, now up to 1.81%. 1.81%. That was like a 170. It's elevated here with some tension to it. And again, people looking for a return to a higher real yield, challenging for corporate America, or like Priya Misra of JP Morgan said, a shockingly low real yield within the disinflation she predicts.
Let's check out nominal yields right now on the 10-year, just north of 4%. Priya Misra of JP Morgan saying 4% on a 10-year. That's a buy. We just about held that level over the last week or so, 4.04%. In the FX market, the euro slightly weaker, 109.38. If you got data out of Germany, you know it's bad. It was bad. Industrial production, not great at all. That currency pair negative 0.1%. And on the S&P 500, following the biggest one-day rally since the middle of November, we pulled back just a little bit, TK. It's early days. We're down 0.4%.
Add a minute or two to the conversation here, because the last time he was on, we got a huge response of what to do with your money. Daryl Chronicles, Chief Investment Officer, Wealth and Investment Management is Wells Fargo. Time stopped the last time you were on, and it had to do with the 60-40 bang up 2023. instead of what's the view forward, what are you hearing from Wells Fargo institutional and retail clients right now? What are they doing with trillions of cash? What are they doing with their Magnificent Seven?
Well, actually, they're still sitting on a lot of cash. They're still parked in that 5% money market fund. They really haven't started to come back off the sidelines with any aggression at this point, notwithstanding the fourth quarter. We know that the 60-40 portfolio, to your point, went up 10.3% in the fourth quarter alone, right? I mean, that is huge, and the whole year was 17% when you took 26 on the S&P and 5.5 on the Barclays Ag. So, but I think they're a little bit cautious here as we start the year. I think when you get below the data, Tom, you need to look at where the strength has come from, and is that strength continuing or is it deteriorating?
My essay of the year, Lawrence McDonald, he's coming out with a new book, folks. Larry McDonald, just walking through the dynamics of the trillions and trillions of dollars of cash. You've got a whole team looking at this. Well, how is the cash going to unfold this year? Stay in cash, move to bonds, actually move into the marginal Apple share?
Yeah, so basically there's $6 trillion sitting in money funds, right, that we know of that has to go somewhere. The fourth quarter ignited that whole conversation of, does it come back in the equity market? Does it go into longer duration fixed income? We're starting to see some of that, but at 404 on the 10-year, we don't think that's a great buy at this level. We think north of 4.5%. In fact, we were long duration through much of the back half of the year that served us well in the big fourth quarter rally. People forgot how bond math works and convexity works, right? Lisa would remember this well, right? But look, you still have to look at, when you look at where strength came from as we closed out the year, it came from the labor market, to your point. It came from the consumer, and it came from small business. We got the small business independent survey this morning, the NFIB, ticked up 1 point, but if you get below it, small businesses are still saying, I'm having a hard time finding labor, credit conditions are too tight, I'm having a hard time refinancing, and prices are still going up on the cost of my inputs, right? So small business isn't feeling great. I'm gonna take the other side of Friday's non-farm payroll report, right? So when you get a layer down, the fourth quarter of the year, 165,000 new jobs averaged, right? That's the lowest average quarter for this cycle, period. 3.7% wage growth, lowest wage growth since 2019, right? So it's decelerating. So that strength in the labor market isn't there anymore. And if I look at the consumer, take the University of Michigan consumer sentiment, 69. Right? The long-term average is 86, right? So why isn't the consumer feeling better when the labor market is held up, when GDP is run above trend, when, they basically are able to spend money at their will? It's starting to erode under the surface, and I don't think enough people are paying attention to it. It's certainly not built into the consensus.
Should I follow how they feel or follow what they do? Because retail sales are still pretty decent.
Retail sales have been pretty decent, but again, on a downward trajectory, right? I mean, you're going to get the first half of this year, if you take consensus, the U.S. GDP is going to be certainly sub 1, it looks like. And if you take the consensus, on Bloomberg, it's 0.1 for the first quarter, 0.2 for the second quarter.
So
that's dangerously close.
Except you're not saying buy bonds. So what are you saying?
Well, we actually think that you can be patient on the duration, so you live on the short side of the curve right now. It's still the highest yields on the board. You play a little defense here, right? Because you are going to get better buying opportunities out into the first quarter, probably the next 30, 60, 90 days. When I look at sentiment, to your point, and positioning, right? The AAI survey is a full standard deviation above its long-term average, so sentiment is extremely bullish. Positioning is back at bullish peak levels, right? Usually those are areas you want to fade and be a contrarian in that kind of environment. Doesn't mean the whole year for 2024 is bad. It just means you're going to get better entry points than you probably have today. So we would caution and warn a little bit of patience here.
The consensus heading into this year seems to be single-digit returns for the S&P. That is very rare, and that's something that people don't talk about. We very rarely get single-digit returns, positive or negative, on the S&P. And I'm wondering where the biggest potential surprise could be. And I've been asking this all morning because I've really been struggling with it. Is it an economic downturn, or is it the opposite? Or is it something political? Is it something that's really not on our radar right now?
I actually think it's the economic downturn that's the biggest risk that's not priced into markets, right? Because again, you have to be a little bit of a contrarian here. The entire macro consensus is soft landing, Fed rate cuts, we've slayed the inflation beast, and we're going to get 11.5% earnings growth this year out of the S&P, right? Good, right? We've got that built into the consensus. Now, if anything kind of comes off the rails, wherever it comes from, geopolitics, the domestic political situation, slower economic growth, all of those have an opportunity to change that positioning. And I think that's, as an investor, what you have to be cognizant of and prepared for.
One thing that I've been picking up from people as they talk today and yesterday and earlier this year, last week, is the threat of oil prices. And if there is some sort of disruption, oil prices go up, supply chain costs go up, that could create a really difficult situation that could really spur some sort of more significant downturn. Is that something you're watching too as a trigger point?
So I think the interesting thing there is not, I mean, we've lived at $100 oil and it hasn't been economically derailing, right? But going from $72 oil back to 100 would sure put a bid back into inflation, right? And buy into that second wave of inflation. Inflation often comes in waves. You know, let's admit we probably have finished the first wave of that inflation by where we brought it down to. We'll see the CPI report on Thursday. But if history's any guide, there's often a second wave behind it. And I think more importantly than inflation in itself, which is a rate of change over any period of time, right? So let's not think about a 3%, 4% rate of change. What we've done is anchored prices at a high level that are not soon coming back down. Right? And that anchoring ends up, economically speaking, always grinds on consumers and businesses over time, that the longer you hold them there, the more it erodes things like sales, margins, earnings, those types of things.
Let's go to Magnificent Seven. When Wells Fargo took over A.G. Edwards, you got great seats for the St. Louis Cardinals.
Yes.
And you also got a guy named Aaron Rakers, who's been really, really good on patience in Magnificent Seven Big Tech. He's modeling out Apple up 22% with a price target of 225. What is Mr. Aaron Rakers, and what do you say to people who say, look, you're telling me to sell the Magnificent Seven? What do you do with those once-in-a-lifetime stocks?
I don't think you can sell the Magnificent Seven. I mean, you got to dance with the one that brung you, right? And tech and communication services brought you here, right? And I think they're going to continue to lead. Whether it's, you can develop your own narrative, and you guys hear it every day. You can say it's the quality trade. You can say it's the fortress balance sheet and the free cash flow and all those types of things that are supporting these names. But the reality is that it is, right? And so you can't afford to be out of those names in this type of environment. We all know that the Magnificent Seven and tech is 32% of the S&P 500, 40-year high, right? So you just have to be there. Now you can trim and take some profits if you've maintained that good exposure through 2023. There's nothing wrong now that we're in a new tax year with taking a little bit of profit and a little bit of capital off the table, playing defense and using that dry powder as we go out the next 30, 60, 90 days.
Hold on to the teddy bears, Bramo. Seems to be the teddy bear stocks. I'd never heard that before.
I mean, I'm just
Ben
trying
Langler.
to imagine someone cuddling with like
teddy bear stocks,
you know,
NVIDIA.
an Alexa and
NVIDIA.
an iPhone and a little semiconductor.
Hey, Darrow, it's good to see you.
You
Ready
too,
to catch
John.
up, buddy.
Thank you.
Thank you, sir. Darrow Cronk there of Wells Fargo. If you are just joining us, welcome to the program. The S&P 500 negative here, 0.4%. Coming up a little bit later, Neil Dutta for Renaissance Macro, 8:30 Eastern Time. The biggest risk for Darryl, a downturn in this economy. The biggest risk for others, a re-acceleration. We'll talk to Neil, Lisa, about that in just a moment.
Are the two the same? And this is sort of the interesting aspect. Could you get some sort of re-acceleration in inflation that triggers the downturn since companies are more fragile after having higher rates, after already having a rollover in certain economic cycles? I mean, these are some of the things people are talking about. Are they the same kind of risk?
I go to people like Aaron Rakers at Wells Fargo and securities analysis into a person they're talking about low, modest, single-digit earnings growth just seems off the mark when they come from the bottom up, John. Forget about the macro. Look at each company, and there's this feeling there of a lift to where we are.
A lift in this market yesterday, pulling back this morning. We're down by 0.4% on the S&P 500. In foreign exchange, the euro not doing much at all, 109.45 against the dollar. And in the commodity market, a rally here, up by about 3% on WTI. We'll talk about crude oil up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The 2024 nominating contests are here, and the candidates are making their cases to voters in Iowa ahead of the caucuses. Bloomberg is live on the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
And at the end of the day, that's what the American people want.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
It all starts Monday in Iowa, only on Bloomberg. Context changes everything.
I think you've had a lot of supply, and as you pointed out, demand is decelerating. Certainly across the world, high interest rates are just putting some pressure on the economy and slowing it down. That's kind of our baseline for the year, slower demand growth. So that combination is I think, what's kind of pulling prices lower. And we just cut our Brent forecast for the year to 80, average WTI 75.
We're kind of there right now. That was Francisco Blanch, the head of global commodities and derivatives at Bank of America Global Research, speaking to Manus Cranny and Danny Berger earlier on this week. Crude right now looks like this. Pull up the board and look at WTI, still in the low 70s, 72, 74, even with a move of almost $2 higher today, up by 2.8%. We just keep going back to the same story, Tom, the tug of war between the geopolitics, the tension, not great. And on the other side, you've just got massive production coming out of America.
And it's always, it's coming out of America, but what will be next? You look at an Excel spreadsheet, as Deutsche Bank used to look at 20, 30 years ago, of the different geographies of oil, John, and there's a huge, huge uncertainty, Lisa.
There also is this question about U.S. production, 13 million barrels, right? We were talking about this incredible record production, plus China weakness. Saudi Arabia just cut prices told to Eastern countries, in part because of a lack of demand. So to try to understand that and then throw in a geopolitical quagmire into the mix, and I guess you have the confusion that we have today in the oil market.
Part of what you get here is the view from a different geography. Nadia Martin-Wigan is director at Zealand Capital. We're thrilled that she could join us today from Oslo, Norway. What is the oil distinction of your Norway? It's not that much production, but Norway gets so much credibility within oil analysis. How does that work?
Thank you. Well, we are, of course, a steady producer, right? We are a country that delivers oil. Of course, we are not at peak production, and we're declining quite steadily when we look forward after 2025, 2026. And on top of that, energy transition as well. We're the forefront in terms of Tesla buying and things like that. But we are very reliable in producing and delivering oil and natural gas, as we saw when this war started in Ukraine.
A two-part question. Is there a one price for oil now, and is that Brent crude? And how does the massive American production change your calculus on what Brent does?
The U.S. market is a huge influencer, and it influences not only the oil price, it influences shipping prices and how movements go all around the world. When we look at Brent, of course, there is the North Sea, which is setting the benchmark, and we look at those physical grades, but they're very small relative to the overall picture. When we see what is the swing crude right now, because of the OPEC cuts, and because Saudi Arabia, yes, they lowered the official selling prices, but they're towing the line and maintaining low production. That swing producer right now is the United States, and that is why it's a huge influence.
It's an amazing change, yeah. It raises the question just how influential the cartel still is. Just how much power do they have?
Well, this was, I think, the big fear that played out yesterday, because by lowering those prices, Saudi Arabia has been saying throughout December, demand is good. But by dropping it so steeply, $2, they're saying, oh, actually, demand is not that strong. At the same time, when we saw U.S. production jump 1.1 million barrels per day year on year last year, oh, are they starting to go for market share? That is the concern. But it's normal for them to cut prices in January. So the market is waiting to see, okay, are they going to be cutting in February, March, and then they start to get worried. So although we had a big sell-off yesterday, we've bounced back, and we think that positioning is still light on this move.
I'm trying to remember the year. When was the market share gain year? Was that 2014, 2015, when they made a massive push for that? And
Yes,
that oil price
absolutely. When we finally got that shale invasion on the global market, which we'd been waiting for, to be honest, for more than a year. And the demand just kept growing in Asia until it broke the back.
Do you think you're going to see a repeat of that? Is that what you're suggesting we're looking out for?
We do not see that right now at all being the case, because the U.S. growth in those years, we were looking at 1.52 million barrels per day year-on-year growth. 1.1 is punchy when the market was expecting 500,000 barrels per day, but it's not enormous.
But there is actually an analogy, which is when oil prices fall to a certain level, the shale patch doesn't make sense, and production stops or slows, and you see rigs taken offline. Are we close to that kind of point? If the U.S. is the swing producer, are we close to them adjusting supplies in response to a lack of demand?
We would need to see WTI trading in the low 60s before I think there is a change in behavior. But because we have such a low DUC count, right, the drilled uncompleted wells, the response will be slower. So this is where we expect seasonally a slowdown in that production, because they're not supersonic prices, they're steady prices, but we're not going to see that kind of growth like we saw last year. The big change, though, is we should start to see rig counts actually increase some, which we didn't see last year, and that's what the market really got wrong.
Bear with me, because this is sort of complicated, but I remember when people argued that part of the reason oil prices were going down was because rates were so high. There was an actual cost to parking your capital in a physical good that wasn't generating the same kind of income that T-bills were. If the Fed cuts rates, could that effectively send more investors into oil and cause oil prices to rise?
It could, yes, because especially the expectation, that demand will be higher, right? So then when we look at our forecast right now for the U.S., we're only seeing maybe 50,000, 100,000 barrels per day year-on-year growth in demand. It can be much higher. When we look at China, the expectation is 400,000 barrels per day year-on-year growth versus 1.6 last year. It's very tepid. So changes can absolutely drive that. The big driver this year, though, is non-OECD Asia, ex-India, ex-China. That's 500, 600,000 barrels per day year-on-year growth that didn't come last year, that we thought would come last year.
We haven't even mentioned the conflict in the Middle East.
Yeah.
And I'm really struggling to even understand what to look for to understand when this will influence oil prices, because everyone was expecting it to and then it didn't. What are you watching for to understand that, yes, this is going to actually have a disruptive influence?
Firstly, we're watching crude flows and product flows, right? So we have seen less Russian crude going through the Red Sea, but that's alongside what they were supposed to cut. So there's no big change there. We're also looking to see product exports out of the Middle East into Europe. Those should really slow down. Those should really pump up middle distillate prices, which then should support oil. That's the part that we haven't seen yet.
I want to take a summary question back to your work at Morgan Stanley at Philbro years ago. All that you've done in commodities, where in God's name is U.S. oil policy or U.S. oil production in 5 years or 10 years? Do you have any sense of the dynamic we have out to 2030?
I believe that there's been a strong understanding that we need to maintain energy security. The reason we maintained lower oil prices last year and the year before was because we had a strong SPR and because we have massive production. So I think the investment will continue to be in natural gas and in oil. China is taking this out of our playbook, being the #1 investor in renewables, big oil producer, importing gas. And so I think we will absolutely continue to do this. However, when we look at these golden patches, maybe there's only 2 million barrels per day additional growth to come. It's still a massive number, 50 million barrels per day.
Squeeze this in just on U.S. production and reserves. So we drained the strategic midterm reserve
a
couple of winters ago. What's left, and when are we refilling it? And are we going to do that going into an election this year?
Well, I think this depends a lot on that relationship with Saudi Arabia, right? When we had this near peace coming before the Hamas attack, we had Saudi Arabia announcing more oil coming back, and then we had immediately after the attack, Biden saying we're going to buy oil at $79 a barrel. They bought a very small token amount. But we're in a happy range, I think, for the electorate. Of course, the electorate would like it lower, but we're not in a dangerous range. So I think slow buying will continue, but I also think we will see policy that is supportive of continued investment in oil and gas, and that will really support things forward.
Nadia, thank you. It's good to see you here in New York City. Nadia Martin-Wigan there as Felon Capital. From New York City, equities just about at session lows. We're negative 0.4% on the S&P 500. In just a moment, we'll talk about the U.S. economy. The data still to come this week. CPI, the highlight of the data this week. On Thursday, we'll catch up with Mike McKee of Bloomberg and Neil Dutta of Renaissance Macro around the table with us here in New York. From New York, good morning.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is the conversation in the commercial break. Neil and I are talking about economics and economic forecasting, and TK wants to know when Man City Tottenham are playing.
It's a big deal. It's a draw. I still don't get the FA Cup. There's Premier League. They play Man U this weekend. Great.
Yeah.
And then there's Champions thing over in Europe.
Champions
The FA Cup is just in the United Kingdom?
This education has been going on for how long now?
I'm totally
honestly.
baffled
I'm
by
sort of giving up. You should have graduated by now. Equity futures on the S&P.
Extension course.
On the S&P
Exactly. I was
500.
thinking, the Phoenix.
We're negative here by 0.44% on the S&P, just a little softer. Yields are up by a couple of basis points on a 10-year 4.0.
Pharaoh quality C.
5%.
Just keep going.
Yields up by a couple of basis points. Is that what we're calling my grades, a quality C?
You're giving me a quality C on football, and that was I was thankful to get that, Frank.
Mike McKee, top of the class. He joins us now. CPI, Mike McKee, PPI. Lots to look ahead to.
No great inflation here. Well, let's get trade out of the way. We get the trade balance. It's negative 63.2 billion. That is down from 64.5 in the prior month. This is a November number, and it's a revision from the first estimate. But basically what it tells us is that the trade deficit is little changed, probably hasn't big impact on fourth quarter growth. This difference between October and November, and we'll see what happens when we get December figures. And at the end of January, we get the fourth quarter GDP. CPI is going to be interesting this week. We've talked about the fact that we're expecting, because of base effects, an increase in the month-over-month rate, which would push up the year-over-year rate on the headline. The Fed's going to look past that and look at the core rate and see that it is forecast to be unchanged, which on a base effect would move the year-over-year number down. Right. But how do the markets look at it? That's going to be an interesting question.
Trevor Weinberg has a blistering note at High Frequency Economics this morning about Europe's behind. He's modeling 1.9% inflation in Europe, whatever. Lagarde's got it going. Is the same pressure with the Fed? Does the Fed have the same pressure as Lagarde's facing at ECB?
Well, I'm hard-pressed to judge exactly how much pressure she's facing, because there's always pressure. I don't think the Fed is facing a lot of pressure yet. What may happen is the pressure builds as the election year goes on. Democrats are going to want the Fed to cut rates sooner to help Joe Biden. And, of course, we know that Donald Trump is not shy about telling Jay Powell what to do.
One question that we were talking about earlier, especially ahead of Michael Barr having a speech today at noon, was a question of what the Federal Reserve is going to do with the short-term funding program that they created for banks to ameliorate some of the risks so that they didn't have to offload treasuries that are underwater. Do we have any sense of how long they're going to continue that for?
We don't. It was done for a year, so it should expire in the coming months, and they haven't given us any indication that they want to change that. And of course, if you start lowering rates, it's going to change the calculation. You may not need it. We haven't needed it basically since the SVB collapse. So I think that one will probably just go by the boards. But these days, you hesitate to make any predictions about what's going to happen in any area of the world.
Politics and the Fed. I know a man who's lined up to talk about just that in just a moment. Mike McKee, thank you, sir. Tune in Thursday. Mike McKee sitting down 11:30 Eastern Time with Cleveland Fed President Loretta Mester later on this week, Tom. That is a must-watch.
It is a must-watch. I've got a huge respect for her. She is the mathematician, applied pure mathematician, if you will, of the Fed. She really understands all the different uncertainties that are out there. Someone that was certitude nailed 2023 was Neil Dutta, head of economic research at Renaissance Macro. He had an optimism about the American economic experiment. Mr. Dutta was correct. Neil Dutta, the chart is out there right now. I literally call it the Dutta chart, which is OMG, inflation's down, and there's a legitimate real wage out there. What does the x-axis look at on our real wage prosperity? Are we going to see persistent real paycheck increases?
It certainly feels that way, Tom. Thanks for having me on. I do think that inflation is on a glide path lower. Mike McKee mentioned the inflation number coming up this week. Well, keep in mind that gas prices will moderate in that report. It's likely that food prices will also moderate in that report. So I think the important thing right now is that inflation is slowing in the very visible parts of the consumer price basket. I mean, that's really what drives expectations, right? I mean, it's the you're spending your money on often.
Let's get it, Neil, just because of time, I want to get this on record for 2024. What's your 2024 GDP call?
I think 2.5%. It's 2 to 2.5%, I think, is a reasonable range.
I mean, I think, John, this is extraordinary to go to 2.5%, and this is the persistence added up over 1 year, over 2 years, over 3 years, and it is American exceptionalism.
It's amazing, Tom, that it takes a degree of confidence to say things are going to be okay. And Neil, essentially what you're telling us is that things are going to be okay. Can we just talk about the profession? We often talk about this with you, that you're always sort of haunted by what could go wrong and the career risk associated with that. Neil, how do you approach that? Just this idea that things can just turn out okay?
Well, I think the base case on society is that we figure things out. I mean, that's sort of, that's been my experience. I think people made a lot of, got a lot of notoriety for getting one big call right. I mean, in 2008, and they've been trading on that for a long time. I mean, so, I remember, being a young analyst at the time, it was sort of wrong, and then spectacularly right. But I mean, generally speaking, it just makes more sense, in my view, to stay on the optimistic, side of the fence. There are times to be concerned about the outlook, but frankly, right now is not one of those times. I mean, we're talking about, generally speaking, the economy has been doing better than most people have thought, and inflation is slowing more rapidly than people thought. I mean, so if you're the Fed, what do you do with that? I also think there's a disconnect, really, in the seat that I'm in, which is sort of a sell-side research role, versus what policymakers are in, or a lot of academics are in. I mean, their job is to protect against the downside. My job is to position clients to catch the upside. So I think it's sort of there's a distinction there that I think needs to be appreciated.
Neil, one reason why I love speaking with you is because you like to be contrarian to some degree. And what you're putting out there sounds like it's not contrarian at this point, that a lot of people would agree with you. Soft landing is increasingly the base case. Does it make you uncomfortable that the rest of the world agrees with you?
No, it doesn't. I mean, because this job is about picking your battles with the consensus wisely. I mean, most of the time, the consensus, it's wisdom of crowds, right, Lisa? But there are times to pick your battles and times not to. And I think, when I look at the, sort of distribution of probabilities out there, I think it's more likely that we have what feels like a soft landing for the time being. There may be risks out there, but there's a significant sort of disinflation in the pipeline. We know that used car prices will continue to moderate over the next couple of months. We know that housing rental inflation will continue to moderate, over the next couple of quarters. That's going to be important. And at the same time, you're seeing renewed confidence in the corporate sector. I mean, this morning we learned that small business sentiment's at a 5-month high. We've seen consumer confidence begin to pick up. Households are feeling better about their personal financial situation. So, this idea that the labor markets are going to spontaneously combust in that kind of a situation, I think is unlikely. And so my sense is that, we continue to see sort of solid, modest jobs growth and falling inflation. So to me, it's, like the last year, as I said, is always trying about, it has felt like, I'm trying to catch the next thing, like the next pivot, like right. Rates go up to 5% now, come down. I mean, right now, I don't know, I feel like let's just catch our breath and, run in place for the next few months.
Neil,
I think the markets and the economy are in a good place.
How much is running in place and a sort of rosier outlook predicated on the idea of oil prices remaining where they are?
I mean, that's part of it, but, gas prices are down, oil production is up, but I think, to me, it's predicated on the Fed responding to inflation as it's coming in, right? I mean, so if inflation is moderating, I think it's important for the Fed to adjust their policy stance. If they don't do that, then the risks begin to build into the economic outlook.
I remember in the early days of Twitter, TK used to put out posts and they'd basically say, Neil, something, discuss. I'm going to do that to you right now, Neil. Politics and the Federal Reserve, discuss.
Well, I mean, you definitely, first of all, politicians should not be kind of opining on the Fed. I mean, I think, Democratic Representative Ro Khanna talked about how he wanted, the Fed to start cutting soon to sort of save Biden's reelection chances. And I think former President Trump was on the tapes recently talking about how he wants the economy to crash. I mean, a very honest sort of assessment going into the election. But look, I don't need politics to make the call that the Fed's going to cut. All I need is the data. It has nothing to do, in my view, with politics. If you wanted the Fed to juice the economy going into the election, they should have already been cutting. I mean, because a lot of the people talking about how the Fed is political have also been many of the same people that talk about long and variable lags and so forth. So, I think in many cases, that topic gets a lot more sort of ammunition than it probably should. But ultimately, I think for the Fed, it's about the economic data. And, look, I mean, how political can the Fed be? I mean, the markets are pricing in 5 or 6 cuts this year, and the Fed is saying 3 at the moment. Maybe they go to 4, but they're not signaling more than the market. So if they really wanted to be political, wouldn't they be saying even more than what the markets are pricing in? So I don't really buy it. I think the Fed's following the economic data as it's coming in. And frankly, if you look at it historically, at the time of the first rate cut, core inflation is running at about 2.2, 2.5% at the time of the first cut on a 3-month basis. We're already there. I mean, believe it or not, core inflation over the last 6 months is below 2%. It's 1.9% at an annual rate. Similarly, the unemployment rate is about 30 basis points off of its low historically at the time of the first cut. Guess what? We're there. We're at 3.7%. The cycle low was 3.4. So I think if you look at it from a historical perspective, the Fed has plenty of ammunition to make the case to cut interest rates. They don't have to cut a lot because the economy is okay. But in terms of like a recalibration of policy, I think that that's likely.
We knew you had thoughts on that particular subject, Neil. We appreciate them. It's good to catch up, buddy, as always. Neil Data there of Renaissance Macro. TK, looking for those surgical cuts from the Federal Reserve.
I think he's where I am. He just didn't want to say it. Greenspan invented measured as far as I'm concerned, and I really have trouble with it. You come out, you're in the press conference, McKee asks a question you don't want to answer, and you say, Mike, we're just going to do one and done. We're going to make a cut just to get it going. And then we're going to sit and observe until Neil Dutta says we can cut again. Why can't they do that? Why do we have to wait for a measured trajectory? Because Alan Greenspan codified it years ago.
We would all love to see you as the next Fed chair. We'd all love that.
Yeah, please.
We don't read the minutes now.
I still wouldn't answer. I'd still put McKee's question last.
Would you read the minutes if you...
Yeah, I'd read the minutes. If you make me chairman, I'll read the minutes.
That's the deal.
That's a promise.
Okay.
Promise.
Okay. If you are just joining us, welcome to the program, particularly the president who might be looking for a future Fed chair. Who knows? Equity futures on the S&P, negative 0.5%. Yields just a little bit higher. We're basically unchanged here, Lisa, 4% on a 10-year.
And really, we're all watching CPI on Thursday and JP Morgan and Bank of America earnings on Friday at a time where otherwise things are just kind of whipsawing. Right now, I'm not sure where the compass is. People just kind of trying to trade and readjust, and Tom yawning as he tries to avoid the meeting minutes, and that's kind of where we are on this.
I think Neil nailed it. We're always trying to chase the next turn.
Yes.
We're always trying to chase the next turn, and you're always trying to chase the next turn. And Neil's basically just saying for him, not much has changed. Doesn't really believe in those long and variable lags. The economy stood up to higher interest rates well. His view, disinflation can continue. Real incomes will look okay. 2 to 2.5% GDP growth. Tom, Fed reducing interest rates. For now, for the time being, that's his view.
The lesson here, Daryl Cronk, Wells Fargo, Neil Dutta, Renaissance, they're not looking at the parlor game tick by tick as entertainment week by week. They're out a quarter. They're out 2 quarters. They're out Q3 2024.
We'll try and get out 12 months with Ira Jersey of Bloomberg Economics and Bloomberg Intelligence up next on interest rates. Your equity markets, session lows. This is Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, "How's October?" I said, "I'll be there because we're not going to the playoffs." And that led a series of 5 or 6 years where I go back to Omaha, and he said, "Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money, and number 2, don't forget rule number 1.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
We're modestly adding to our positions in fixed income. We still look at the income on high quality bonds as a great way to sit here, get paid to wait. Right now, the pivot party's feeling a little bit like maybe a hangover. Maybe we're like trying out dry January here or something, as the markets are now back to this good news on the economic front, which is causing yields to back up, being sort of bad news on the equity.
We transitioned pretty quickly there, didn't we? Emily Rowland of John Hancock, from Emily Rowland's pivot party of late 2023 and Bramo's sober January of 2024. It's kind of been the story of the last, I don't know, month or so. Your equity market on the S&P 500 pulling back by 0.6%. Actually a decent day of gain in yesterday's session. The biggest one-day pop going back to the middle of November on the NASDAQ 100. That was a gain of more than 2%, a tidy day of gains, led by tech stocks like NVIDIA, but also consumer discretionary names as well. The financials had a really difficult time through much of last year, and then things turned around to the back end of the year. And Lisa, you'd have to say that was very, very dependent on what happened in the Treasury market all year.
Which is counterintuitive, because you think higher yields, more income for the banks. But if the Fed is going to cut rates, the feeling is this could unleash capital markets activity and really reignite some of the profits that we saw missing from the likes of Jefferies. We could see that for the past year, JP Morgan, Bank of America, Citigroup, very different performances. JP Morgan leading the charge, up 25%, Citigroup up 14%, Bank of America the laggard, all of them reporting earnings on Friday. Why is Bank of America the laggard? And John, to me, this is interesting, partly because of their portfolios of treasuries, which raises this question. If the Fed does end this program, does the treasury holding of a bank like Bank of America become more of a liability now that they have to,
What about the smaller banks? There's been a lot out in the zeitgeist about the smaller and regionals far more affected than Fortress Moynihan.
Well, Tom, I think this just raises the question across the board. What's more important to these bank stocks for the rest of this year? Is it the guidance you get on Friday, the following Tuesday, or is it where the 10-year yield finishes the year? What's more important for the year ahead?
All I know, Lou Crandall was quoted, I think it was in Zero Hedge. Lou Crandall is the giant. He basically invented analyzing short-term paper. And Lou's got some real concern about what these smaller banks, these lesser banks do, if you will.
The regionals, yeah.
Legit.
Many of them still holding on.
We're going to move forward with this discussion, and we can do that with Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence, only talks to us on Fed Day. We dragged him out of storage this morning to start the year strong. Ira, I don't know if it's the chart of the year, but I know it's the Ira Jersey chart. All you need to know on radio is interest rates were 0, and Ira Jersey went out and pulled together all the different money market fund yields into a ginormous 5% yield with a huge buildup in assets along the way. Ira, where are we in 1 year? Are we going to unload our money market funds and put it other places?
So I actually think that money market funds will continue to be the investment of choice for people who don't want to take a lot of either interest rate risk or equity-like risk, just because you're going to still probably get much more than you can, say, in a bank deposit. Remember, Tom, most of the money market assets that you've seen flow in haven't been from riskier assets. They've really been from bank deposits, and that's one of the reasons why you had, still some angst among some banks that they, are losing their liability base, which is these deposits, and that is something that regulators certainly are looking at very closely right now. Is how can banks maintain their deposit base when interest rates are so different between the instruments?
And the distinction here is liquidity, no, but much more solvency, the dynamic of bank balance sheets. Are we at a solvency risk for not all, but some of our banks?
Well, better question for our bank analysts, but I don't think so. I think the low-hanging fruit, the banks that didn't do a great job hedging, didn't necessarily have the properly diversified portfolios, those are the ones that are probably out of the way right now. And not only that, but I think that there's some more confidence in the banks because it's pretty clear that the Federal Reserve and other regulators are willing to step in to provide enough liquidity for banks that have okay assets and have only been losing on a mark-to-market basis as opposed to having a lot of credit losses. Because that was the interesting thing back in March, right? The banks that lost money lost it because of basically bad trades as opposed to bad assets, which are two different things.
How far do yields have to come in for them not to be an issue for some of the existing holdings still out there on bank balance sheets, but also just in general for investors who haven't wanted to sell and be underwater?
Yeah, so I mean, if you were holding 10-year treasuries, 3 years ago when interest rates were at zero, and now, those same assets are upwards of 4%, obviously you have a big mark-to-market loss. Now, the difference is, and I think that this is an important distinction, if you hold a mutual fund or an ETF that invests in bonds, those are structurally lower, and those are what we call constant maturity instruments. So those instruments are always buying new bonds, selling bonds when they go toward maturity. But if you hold, say, a 2% 10-year bond from a couple of years ago, that's now a 7-year bond, and eventually that will mature at par. So yes, you're losing opportunity cost in terms of interest, but you're also not really losing principal unless you actually sell that instrument. So I think that's always a problem that you have in fixed income if you're going to hold to maturity or not. And if you don't, and you say reinvest that at higher yields now, it's not going to change your investment profile very much.
I've been trying to spend the past 5-6 trading days of 2024 creating a narrative that's going to exist for the entirety of it. And one thing that people keep talking about is that it's going to be a trading range kind of year, that they're going to look and try to just sort of readjust around where we are right now. Is this basically a trader's market and everyone's living in it?
I think near term that's very true. In fact, we actually think, I noticed a headline from Bill Gross this morning. He's saying that he thinks that even at 4% that 10-year yields are overvalued. And part of the reason for that is that we're already pricing a lot of Federal Reserve cuts, and we're pricing for a pretty bad economy. Now we have to wait to see, will that materialize in the near term? And then once we see the data go one way or the other, either you're going to have weaker data that's going to prove that the Fed is going to cut. That means that 10-year yields will probably rally. And if you don't get a particularly bad economic outcome over the next couple of months, then maybe 10-year yields stay here or maybe even sell off 15, 25 basis points.
Ira, good to catch up, sir. Ira Jersey of Bloomberg Intelligence, just framing that debate right now in the bond market, the range for treasuries. Marko Kolanovic of JP Morgan pushing back against some of these calls. Listen to this. Disinflation not likely to be sufficient for rate cuts by March. Absent a growth threat, our central view is that it would take more time for central banks to reach the conclusion they can start reducing interest rates and to look to mid-year as the most likely time for DM central bank easing to begin. Not pushing back against the concept of cuts, Tom, just pushing back against the timing of them.
Yeah, well, I think Bruce Kasman was there. I don't know if he's reading Kasman's literature, but there is an argument being made out there that March is a little bit rushed, particularly with the institutional heritage of the Fed. And we can get things done in June, and that's one of the beliefs out there.
Marko Kolanovic also pointed out that rising geopolitical risks and potential supply chain issues might reignite inflation, and sort of raises this question: what's the bigger risk, recession, or not even recession, but just a downturn that's not expected, or reinflation? And if they're the same risk, and it could really come down to something geopolitically, How do you prepare for something like that when it's just, one of those things that could happen?
Those are the sum of all our fears. And I would take someone like young Dutta and link him with older and respected Yardeni. Ed Yardeni writing last night about this in his notes. There's always fears out there, individual and particularly aggregated together, as Alarian would say, the unknown unknowns. You know what? People wake up to go to business. The most important thing I heard today was small business is back up off some really ugly numbers.
Confidence, yeah.
The confidence is, is it robust? No. But it's there, and we're open for business. And I just putting in my, you guys were babbling on about something,
Thanks.
and I put in my order for my Apple Vision
Of course you did.
Pro.
$3,000.
Can you see me with the Apple Vision Pro thing going on?
Neil Dutta,
Afterthoughts on
by
it.
the way. Great conversation. Find that on Bloomberg.com and on the Bloomberg terminal. TK, colleagues that don't take off the holiday period when they probably should take off the holiday period, when it's really quiet and there's no work to do, and then they take like the second week of January off. Do you know those colleagues? Those kind of colleagues, where things start to get busy,
jerks.
then they go,
They're such
then they
jerks,
go
all of
skiing.
them.
Aren't they just terrible?
Yeah, they're horrible people.
You have the holidays, it's really quiet, everyone should take time off, and then you always have that group of individuals that are
Okay,
super
can we just
strategic
stop?
about it, and then the second week of January, they're like, it's time to go skiing. Bramo's going skiing. Bramo's going skiing.
It's like, she's like,
We're going to miss you, Lisa.
Thanks.
Enjoy the slides.
I would say.
Which continent are we going to this time?
Well, look, I mean,
Is this like a Bond movie? Are you in Italy?
By the time we go next week, it'll be another narrative, and it'll be another.
Very
objective.
cool.
People will be
Now you
resetting.
enjoy yourself.
Thank
you deserve
you.
it.
I appreciate
You have
that.
fun on the slopes. From New York City, this is Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From New York City, for our viewers worldwide, I'm Manus Craney in for Jonathan Farrow. As you can see, there is a lack of belief from Morgan Stanley, JP Morgan, and HSBC. Time to de-risk your equity trade 2024. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, markets are on the edge. Stocks and bonds resume their declines. Investors brace for key inflation figures and the start of the earnings season. Over on Capitol Hill, it gets back to work with a busy week ahead. We begin with the big issue. Prepare for higher for longer.
The risks are that the Fed's going to keep rates higher for longer.
Higher for longer interest rates?
The expectation is that the Fed will cut rates at some point. The question is when and by how much.
The risk would be those rate cuts get priced out because inflation kind of turns higher.
The markets are so wedded to this idea of dramatic cuts from the Fed.
It's the rate side that has gone a little bit too far, too fast.
They're not going to materialize, and I think some repricings will come.
As that gets at least partially unwound, partially priced out, that leads to that reverse Goldilocks.
A reverse Goldilocks.
Usually that kind of reverse Goldilocks environment is basically you can't buy anything.
We've been saying for quite some time that 4% is fair value.
It's really an environment now where it's not the classic risk off.
The early part of the rate cutting cycle will see yields fall.
What you are is more susceptible to gyrations in yields more than anything else.
Did you get the message? Reverse Goldilocks, she's in the building. Joining me now to put some context around that, Aberdeen's Luke Hickmore and Mike Kontopoulos of RB Advisors. Gentlemen, good morning. So we've now got a shift in the narrative across the houses. We're backing up in yield. Reverse Goldilocks is arriving. Mr. Hickmore, good morning. It's been a while. The temptation is to neutralize everything. How careful must I be not to throw baby out with the bathwater? Good morning.
Morning, Manus. What a pleasure it is to be on with you. I think the bears eyeing up Goldilocks' dinner. And it's a real problem for investors who have had an amazing Christmas period. The run-up through to the end of Q4 was huge across all asset classes. It had clearly gone too far. This pullback seems incredibly sensible. Don't get caught up too much in this narrative, though. I think this is the year where you dollar cost average. You think about your positions. You want to be long duration, long investment grade credit, long banks, nervous about tech, and slowly average into those positions because the volatility otherwise is just going to wipe you out.
Okay, heresy, nervous about text, but maybe prescient. Let's take it across to Michael. Good morning, good to have you with me. There you go. We say reverse Goldilocks is attempting to steal the porridge. You say it's time not to be a hero. Can you translate what that means, not to be a hero and take a lot of interest rate risk now? Does that translate to de-risk?
Yeah, Luke, I think there's a couple things that I would highlight. I mean, I would actually disagree, Manus, I just actually disagree with Luke a little bit with regards to his assessment. You know, we actually really don't like investment grade credit here. We don't really like duration here, as you mentioned. It's really not time to be a hero in either one of those two asset classes from our point of view, but for very different reasons. You know, credit spreads are incredibly tight. And I agree with, you know, the intro here with many of your guests, prior guests, saying that, you know, the number of cuts priced for the first half of this year is pretty much way overdone. And in fact, what you're likely to see is a much stronger economy than the market expects. You're most likely to see a Fed that stays on hold for much longer than the market expects. And where's the pricing for the, you know, another hike? We haven't seen that yet. And so I think things are going to have to get priced out pretty meaningfully. And in that world, you know, you look a lot more like 2022 than the last 2 months of 2023.
Well, 2022 was pretty bruising for risks. You can't throw a wrench in like, you know, we haven't priced in the possibility of a rate hike. Do you really think that's even possible or on the table, or is it just higher for longer and rates delayed? Michael?
You know, I think you can absolutely have some probability assigned to another hike. I think the market has gotten way ahead of itself. I mean, inflation is still over 3% across the board, core and headline. And as you get closer to the summer, you may actually see inflation start heating up. You know, you're seeing a number of inflation measures that are not coming down to the extent that the Fed would like them to. And if you hang out in the 3.5% range with unemployment at sub 4% and profits accelerating, why is the Fed just going to hold rates where they are?
Okay, let's take that over to Luke. I mean, I'm going to assume you're going to take the other side of that trade. I mean, there is a tail risk of another hike. Nobody's talking about it, but there you go. We got it on the table for Tuesday morning. Hickmore, do you take the other side of that trade?
Yeah, I do, but cautiously.
Okay.
Where I do agree with Mike is that things have moved into richer territory, but that's my point. You step in slowly during this market. You buy the dips. Use that from the technology teams. They've been buying the dips for years. Sell your tech, buy your bonds, but do it slowly.
Judicious deployment of capital. I think that's the phrase that most sales men and women would try and use to me at this juncture. I've got a meeting with somebody this week. I wonder what they'll tell me. Investors are digesting the latest Fed speak. They're bracing for Thursday's key print on the inflation side. Mike McKee is with me to soothe the bond market's nerves. Will the print soothe the nerves? Mike, good morning.
That's an interesting question because, as we've discussed over the last couple of days, headline CPI is probably going to go up a little bit, core stay unchanged, and on a year-over-year basis go down. What happened yesterday was interesting, though, because Mickey Bowman, the Fed governor who's been the most hawkish on the Open Market Committee, said that if inflation keeps falling, rate cuts will eventually become appropriate. And people took that as a sign that the Fed is done raising rates. Raphael Bostic also spoke, the Atlanta Fed president, saying he sees 2 cuts this year, nothing like the 6 the market see, and the first one not till Q3, which brings up that higher for longer aspect of it. Now, one of the monkey's wrenches in, or I guess, Manus, we should say spanner in the works for you, is borrowing costs out there. Borrowing costs, you can see the yellow lines, that's the Goldman Sachs Financial Conditions Index, but borrowing costs have not significantly dropped. They are still fairly high, but if they follow the Financial Conditions Index down, then Mickey Bowman says we could have a problem. There's a risk that the recent easing in financial conditions encourages a reacceleration of growth, stalling the progress in lowering inflation or even causing inflation to reaccelerate. There's another risk too, Manus, and that is that even without borrowing rates falling, we might see problems. This is the consumer credit numbers that came out last night from the Fed. You can see over on the right-hand side a big jump in credit card spending in November. And the white line there is the credit card interest rate, the average interest rate. Went way up, still up, not coming down, but people are spending more money anyway. That's a recipe perhaps for overheating, and that makes the case for more Fed tightness. So at this point, it is really data dependent, and we don't necessarily know. I think they'll stand pat in January, but we don't necessarily know whether they're going to be cutting at the rate the market wants.
Okay, well, let's see what the CPI print is. Mike, thank you very much. A little bit later in the week, my guests this morning, Luke Hickmore and Mike Kontopoulos. So with the last chart that we showed, there was the New York Fed inflation expectations 1 year forward. Beautiful, beautiful ski. Just a beautiful, smooth run down. It's a bit like me on pair of skis. Not, I tell you, it always ends brutally, badly, and my friends go, we're never skiing with you again. So here we are, we're sub 2%. Are you convinced that this has been vanquished? Inflation has been vanquished, or is there a risk that it repops? Mike?
Yeah, I think there's absolutely a risk here. I mean, look at the NFIB small business pricing plans, which tend to lead inflation. They've reaccelerated for a number of months, notwithstanding a little, notwithstanding a little bit of a dip over the last month. But you look at that chart over the last day, and it doesn't tell good things about the where inflation is going. And so rental inflation is not coming down like folks expect. And so as you look at sort of the real core measures of inflationary pressures, they're not coming down to the extent that people think they are. And then you couple that with a profit story that is quite favorable. We expect profit growth to accelerate towards mid-teens by end of Q2. And why are companies going to start firing in that environment? And so wage growth is going to continue to remain somewhat elevated. That's not a recipe for drastically falling inflation in our view. So I think you're going to get some surprises to the upside, and the market's really going to have to reprice things here.
Okay, and Mike, you're going to have to bear with me. I'm going to have to give Hickmore a question for his own audience. I got PIMCO on a little bit later on, Mike, Luke, and looking at the 20-year bond auction this morning, record demand. That's what you call munching on duration. Would you be a buyer of UK gilts? PIMCO see opportunities outside of the United States of America. Do you want to feast on a few gilts, or are you worried about the vigilantes later in the year in the UK?
I want to see that 4% yield in gilts as well, to be fair. I think we're a little bit off yet from re-entering that market. My clients are short, our clients are a little bit short duration versus their benchmarks, all short in an absolute sense. I think the vigilante point's a really fair one, and this is around the idiot premium that Liz Truss left us with after a mini budget a year and a half ago now. That's still with us, and the theory's been that whoever wins the election is constrained by the bond market, constrained about how much they can borrow and how much they can spend. The bond market has already told them, let's not be silly with it. I think actually the parties are listening to that. I'd be really surprised if we get to the election at some point this year and they've decided to throw the baby out with the bathwater and blow up the gilt market again.
Well, I'm excited to be here for one election cycle anyway. Luke, stay with us. Mike, we'll get back to you in just a moment. Mike Kontopoulos there and Luke Hickmore joining me now on the stocks move ahead of the opening bell. Abigail Doolittle is side by side with me. What have we got, Abigail?
Well, Manus, we do, of course, have futures drifting to the downside. So weighing this morning are, among them, Netflix. Shares are down. This is Citi cuts the streaming company to neutral, and lofty expectations and upcoming risks equaling revenue estimates looking, quote unquote, a tad too high. JetBlue is also down nearly 5%. This is CEO Robin Hayes yesterday announced that he's stepping down. He's to be replaced by Joanna Garrity, the current president. Hayes is citing uncertainties for the company, health and family. But we do have a big winner, and that is Juniper Networks, up nearly 22%, soaring in a report that Hewlett-Packard Enterprises is in advanced talks to buy the company for about $13 billion. It could potentially help them navigate the AI scene, and this deal could be announced officially as soon as this week, Manus.
Yeah, we're getting a few deals come through in pharma and in tech, so it could be the year of the deal returning. Investment bankers of the world unite. Your bonus is getting made as we speak. Abigail, thank you very much. Coming up on the show, Secretary Blinken visits the Middle East amid rising tensions.
It's clearly not in the interest of anyone, Israel, Lebanon, Hezbollah, for that matter, to see this escalate and to see an actual conflict.
Geopolitical risk and markets. That's part of the conversation next on Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
authorities.
Could face bigger challenges. Britain's next.
Was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's clearly not in the interest of anyone, Israel, Lebanon, Hezbollah, for that matter, to see this escalate and to see an actual conflict. We've had 40 countries come together to make clear that what the Houthis are doing has to stop, and we have other countries that have made clear that if it continues, there have to be consequences. So, our strong view, our strong preference, is that the Houthis get the message that they're receiving from countries around the world that this needs to stop, and that's what we're focused on.
And these tensions are escalating further after a drone strike in Lebanon. An Israeli drone hitting a car, killing 3 people. That's just one day after a similar attack killed a Hezbollah commander. The Secretary of State, Antony Blinken, there meets with the Israeli Prime Minister Netanyahu and other top officials. This is day 4 of his trip to the region since October, as the White House tries to avoid broader conflict. Blinken saying earlier in the week, quote, "This conflict could easily metastasize." Bloomberg's Kayleigh Lyons is tracking this story. He's touching down there. This is a whirlwind tour. Kayleigh, what do we expect in terms of progress of the narrative from him? What will be the key message coming from the Netanyahu meeting?
Well, Manis, the message is likely to be very consistent with what the U.S. and the Biden administration has been saying for some time now, which is that they would like a de-escalation in the conflict between Israel and Hamas. It's war that is taking a massive toll on Palestinian life in Gaza and pressuring the U.S. very much so at home. President Biden, when speaking in South Carolina yesterday, actually had his speech interrupted by protesters chanting "ceasefire now," to which the president responded that he understood their passion, and he's been quietly working with the Israeli government to get them to reduce and significantly get out of Gaza. And that is the work that we expect Blinken is continuing as he meets with Netanyahu and other top Israeli officials today. But that really is just one part of this equation, Manis. On the one hand, yes, it is about the conflict between Israel and Hamas, but also the U.S.'s desire to not have that conflict spread into something much broader regionally, especially as you were alluding to, developments in recent days, the Hezbollah commander that was killed by an IDF strike yesterday. And now Reuters actually reporting today that Hezbollah in turn has attacked an Israeli army base with explosive drones. And that follows Blinken saying that it is in nobody's interest for an escalation in the conflict between Israel and Hezbollah, which is, of course, one of those important Iranian proxies, as is Hamas and the Houthis as well. And that is another issue that the secretary is having to grapple with, what's happening in the Red Sea, the disruptions caused by Houthi attacks on ships. Blinken warned yesterday of consequences for Houthi militants if they continue the attacks, which raises the specter of potentially more offensive action from the U.S. and its coalition of forces it's working with, rather than just the defensive measures we're currently seeing.
Kayleigh, thank you very much. Kayleigh Lyons there tracking Antony Blinken's trip around the Middle East. My guests this morning, Luke Hickmore and Mike Kontopoulos, are still with me. If I'm to be brutal in the analytic, there is no war premium across these asset classes, and that is because until it's in your own backyard, it doesn't matter to markets. Luke Hickmore, how folly is this of markets? A distant war in a distant land remains a material low risk to markets.
I actually think it's on every investor's minds. We all know this is the year of the election, and not just the big one in the US. There's 40 of them across developed markets, emerging markets. We're going to see them hit us again and again and again. We all know about political risk this year. Geopolitical risk has been in our face for the last 2 years. I think there is some exhaustion from the market about pricing that in. But we've also seen a reaction from things like freight rates. GTV, great function on Bloomberg. This morning had a brilliant chart on how freight rates on shipping are just starting to creep back up again. We've seen this come through in inflation, and everybody's got to be worried about that again. And I agree with Michael in this sense that we could see inflation come back, and it could be easily caused by all of the after effects, all the side effects of all these conflicts that are happening.
So with that in mind, Mike, is that what is in the back of the market's mind, but just not priced? That's not what's shifting bond and credit prices right now, is it? It's about fiscal, and it's about supply.
Yeah, I think that's right. This is the bond market's definitely not pricing in much geopolitical risk. Listen, I don't think there's really much of a way to do that, right? You have to play the cards you're given, and right now, you know, the fiscal and the supply pictures are what are the knowns, and that's of course what the market's going to trade on. And so we'll see if that changes over the course of 2024. But I honestly think that's probably the right way to be trading the bond market and the equity market for that matter.
Okay, let's set you up. Let's give you the score on this one. You say, Mike, we're going to go through a slow-moving credit crisis. When people say the words credit crisis to me, I kind of asphyxiate because it brings back horrible memories to me. What kind of credit crisis are we going to have? And then, Hickmore, don't think that you're getting off the hook because you also have a view on where we go with the banks as a consequence. So the pro quo, Mike, first of all, what kind of credit crisis am I going to get? And is it going to be as bad as 2008?
Yeah, no, absolutely not as bad as 2008. So crisis maybe is too strong of a word here. And I also don't think it materializes over the next couple quarters. But I don't think there's any doubt in our mind that, listen, at some point, higher interest rates are going to bite corporates pretty hard. Spreads are incredibly tight right now and not compensating you for that risk. And so as we look out towards the second half of 2024 and into 2025, as refinancings go up quite a bit, particularly in high yield, I think that's going to bite pretty hard, and you're going to see many more defaults. But again, that's not a first half 2024 story, and that's why it's really slow moving at this point.
Very briefly before I go back to Luke, is there a kind of a level on high yield or investment grade on the blowout in spreads that you would seek to re-enter?
You know, it's hard to say that. I mean, we tend to be, although we care about level, of course, we tend to invest more on what's happening in the macro backdrop than just on the level itself. And so, I mean, certainly if you get north of 165, 170 basis points in IG and north of, 650, 700 basis points in high yield, those levels are incredibly attractive. But, a lot will depend on what's going on in the macro environment as well.
Okay, and just over a minute, Mr. Hickmore, you have a proclivity for bank debt, not the equity. You're shifting a bit. With the landscape that Mike has just outlined, do I just leave bank debt and equity alone in totality? There you go, 13 years, you've had a strong opinion on not buying the equity, but going towards a little bit of frisky CoCos and AT1s. And I know you were scathed in Credit Suisse. You weren't the only one. So how do you look at banks? Briefly, in a minute.
Banks are cheap. I think the UK banks in particular are very cheap. They trade on ridiculous forward price to books. Barclays at 4 times should be on 8 times. UK consumers actually in a pretty good place. Look at the US. Look at what's been going on with credit cards. Morgan Stanley's up 30% in the last 6 months. Barclays is barely changed. I think there's some real opportunities there for investors to get on board with bank debt now, slowly building up into their portfolios. And you could be looking at 20, 30% returns rather than 10 or 11% return on your CoCo AT1s.
In 15 seconds then, I take it you're not seeing a slow-moving credit crisis?
Absolutely not. I'd be buying investment grade on dips. I wouldn't buy yield.
You two boys can come back again. There you go. You got a bid and an offer. It's the immaculate market. It's the bid and the offer and everything. You can give one another a call and do an OTC trade. Luke, thank you very much. Luke Hickmore, good to speak to you again. Mike Kontopoulos, my guest this morning, dissecting the markets, credit and rates. Coming up, your morning calls. PIMCO's Tiffany Wiley will join me a little bit later. She'll make her case on the bond market for 2024. That's ahead of the opening bell, her cyclical outlook. Looking forward to that. Right here on Bloomberg.
What do you worry most about your economy and in Greece. And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Time for your morning calls and look at some of the analyst recommendations on Wall Street today. First up, Citigroup downgrades Netflix to neutral, citing lofty expectations and a series of upcoming risks. Bank of America upgrading United Airlines to a buy from underperform, highlighting favorable valuation and strong balance sheet. And finally, Morgan Stanley downgrades PayPal to equal weight, noting slower than expected progress on key strategic initiatives. Coming up, PIMCO's Tiffany Wilding joins me to unveil her cyclical outlook for the year ahead. There are opportunities beyond the American borders, according to Tiffany. We'll run through what they are and whether that includes the gilt market right here on Bloomberg. Good morning.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Countdown to the Open. I'm Manus Crenny in for Jonathan Farrow. We're moments away from the start of cash trading. The confidence in that small tech rally that you had yesterday seems to have dissipated. And as for breadth, well, the Russell 2000 down 1.45%. So this is about a mounting wariness from the analysts across the market. Morgan Stanley, HSBC, we've just had a couple of guests there saying, be careful in terms of taking equity risk. There is the opening bell. Let's roll it over. Have a look at some of the cash prices for you. We'll see what the rest of the assets are doing this morning. You've got the euro dollar flat at 109.44. 10-year yields, fair value. Well, Bill Gross doesn't think it's fair value at 4%, that's for sure. He'd far rather tips at 1.8%. You're going to see a further backup in yield. We've just had a conversation about the risk for a slow-moving credit crisis. That may well come. Not a car crash like 2008, but risk is there. Oil bounces 1.72%. Anthony Blinken touches down in the Middle East on his Herculean tour. One stop to watch, it's Boeing. The plane maker's continuing fallout. This is loose bolts being found on the 737 MAX 9 jets that are being inspected as we speak. Abigail Doolittle has the details. What have they found, Abby?
Well, it's hard, Manus, to believe that this could all come down to 4 bolts, but that's exactly the case. Investigators right now are looking for 4 missing bolts. These are the bolts that would hold that door plug into the side of the plane so that it would stay on the side of the plane and the plane would stay pressurized, as opposed to that door plug blowing out and the depressurization and the horrors that the people on that plane suffered for about 30 minutes before it thankfully landed safely. Now, Alaska Airlines and United have found 737 MAX 9 planes, other planes that have been grounded, because of course the FAA over the weekend did ground 171 of those planes. Missing bolts, there was a missing washer in India. On this particular plane, it was basically brand new, 2 months old. There was also a pressurization fail light that had lit up 3 times. So it wasn't allowed to fly long distance. A Bloomberg scoop, the plane had Wi-Fi installed after the fact. So it seems like there were some issues for this plane. As for Boeing, this stock is down again. It could get worse for them if the FAA does in fact ground all of the other 737 MAX aircraft, such as the 8 that were involved in the 2018-2019 tragedies. This really puts clearly a stall in their turnaround beyond the apprehension that you and I, the average civilian, might have about getting on one of these planes. Ryanair CEO Michael O'Leary said Boeing has to improve their quality control. As for the stock, it is again down today. Yesterday, the worst day since October of 2022, falling 8% on the year, down more than 10% since its all-time high, Manus. This stock is still down about 50%.
Yeah, some big challenges for the CEO, I would say, Abby. That is going to be the next iteration in this story. Abigail Doolittle on the Boeing woes. Let's turn our attention to M&A. Wall Street Journal reports that Juniper was in advanced talks to be sold to HPE. Simone Foxman is here with the details. Run us through them, Simone.
Yeah, Manus, journal sources saying this deal could value Juniper Networks at $13 billion. That's a pretty big deal for Hewlett-Packard Enterprises, which as of last close had a market cap of just $23 billion. HPE, cloud services provider, it was spun off of HP, the computer and printer maker, back in 2015. And its revenue growth has really plateaued over the last couple of years at about 2%. November, in last earnings call, said it reported a steeper than expected decline in some of its server sales. Juniper also far from its flaming days of the tech bubble, down 80% since hitting a high in 2000. It makes routers and switches that direct information across the internet and sells the likes of Amazon, Microsoft, also AT&T. The whole deal, though, really focused around artificial intelligence. Juniper has an artificial intelligence business called Mist AI, and that's seemingly where HPE wants to get in. Bank of America says this would actually deviate from HPE's overall strategy, which has really been towards a services model. This would be potentially a little bit more into the hardware space, but it does have some merits: access to new consumers, bigger footprint in networking. And Bloomberg Intelligence, despite the size of this deal, says it's not likely to affect HPE's overall investment grade rating. That said, we are seeing the shares react this morning. Juniper Networks up over 22%, while Hewlett-Packard feeling the sting, down over 7% in today's trading, Manus.
Yeah, chunk of change out of that, over 7% lower. Simone, thank you very much. Let's turn to the world of dating apps. The Journal reports that an activist investor, Elliott, has built up a stake of $1 billion in Match Group. Alex Semenova joins me now. $1 billion for love.
Hey, Manis, good morning. Well, it is certainly a good day for Match Group, which is the parent company of Tinder and other online dating platforms. Shares are on pace for their best day since November 2022. This is after the Wall Street Journal reported that Elliott Management built a $1 billion stake in the company. Elliott is set to push Match to take steps to boost its stock price. That's according to the report, which cites people familiar with the matter. Aside from that, Elliott's specific demands, like whether it plans to revamp its board, were not immediately clear. The activist investment firm is, of course, known for taking stakes in beaten-down companies and vying for changes to boost shareholder value. That makes Match, dare I say it, the perfect match for Elliott, given the fact that the stock was down 14% last year amid competition in the online dating space and struggled to retain users. The positive reaction, too, is no surprise today, given Elliott's track record. Elliott has engaged with about 60 companies since 2020, and 1 year later, most of those stocks were higher. That's according to Bloomberg data. Analysts at Piper Sandler said that driving up revenue growth and free cash flow growth are among top of the list of possible items for Elliott, and they said that wouldn't hurt to have an extra pair of eyes on Tinder. Manis?
There you go. The price of love, $1 billion and an opportunity. The question is, are we going to see a price-cutting war for premium access and a swipe? Alex, thank you very much. Turn to the customers now, the consumer. How is the consumer? Urban Outfitters rising. That's after November and December net sales increased 10%. Katie Greifeld has more. Yesterday, Lululemon. Today, you're all about the retail now, Katie. How are you?
All about the retail. Well, that's because it's a big week for retail. Of course, we have the ICR conference this week. That's why we keep hearing from these retailers. We heard from Lululemon and Abercrombie yesterday, both of those chains lifting their outlook. And the party continues today with Urban Outfitters. The news there, we have shares rallying right now. The company said yesterday afternoon that same-store sales at Free People and Anthropologie, those are two brands under Urban Outfitters, they jumped by 20% and 14% respectively. Now, that was enough to offset weakness at the namesake Urban Outfitters brand that posted a 13% drop in same-store sales. You add it all together, and November and December net sales increased 10% versus those two months the prior year. So you put it together, and this is good news for Urban Outfitter, and that is definitely the thought process behind this Bank of America price target upgrade that we saw, lifting the price target to $45 from $42. The analysts there see further margin expansion potential for the company after, quote, a strong holiday. You take a look at shares right now, they're currently up almost 16%, or rather 6%. That would be its best day since about May or so, Manis.
I think my days at Urban Outfitters are over. I'm much more kind of like Paul Smith, slightly tailored and slightly more aged. Katie, thank you very much. Katie Greifeld there with the very latest on Urban Outfitters. PIMCO's Tiffany Wilding is in the wings as we start the new year writing this. The global economic outlook still clouded, and equity markets are priced for a soft landing. Bonds offer attractive yields and resilience across multiple possible outcomes. Tiffany joins us now. Weigh in. Good morning, Tiffany. Good to see you. These bond markets have been shaken a little bit. We're above 4%. I hear the supply issues you raised in the autumn time. Bill Gross doesn't think that they offer value at this point. On sovereigns in the US at around the 4.25%, do you want to scale back into this kind of sovereign debt at these kind of levels? Good morning.
Well, good morning. Thanks for having me. Yeah, I mean, so we think for longer-term investors, the bond market still provides a lot of value. You know, if you look at high-quality credit, securitized markets, you're still getting relatively elevated yields, especially if you think, as we do, you know, that ultimately the underlying neutral interest rate in the U.S. economy, you know, is probably still around, you know, 0 to 2% on a real basis. And if we compare that to longer-dated real yields, for example, you know, they're still elevated. You know, but nevertheless, you know, and this is where it's important to have, you know, an active bond manager. You know, nevertheless, when we look at, you know, the front end of the interest rate curve, you know, the Fed funds futures strip, you know, we do notice that there's a lot that's already priced in terms of central bank cuts just in the near term. You know, so I think, you know, over the longer term, bonds provide value. Kind of as a tactical trading perspective, though, you know, the bond market's priced in a lot in terms of cuts.
And to a certain extent, we've discussed that now for 6-7 days in a row. We've seen this retracement. you titled your piece at the start of this year, Navigating the Descent, and I'm curious the kind of rate cuts and the rationale for rate cuts this year. You've looked at history, and you talk about rate cutting in recession-like environments and rate cutting in non-recessionary environments, the 1995 style soft landing. So what will we get from the Fed, 3 or 6, or something a little bit even more muted than the 3 that the market has priced in?
Yeah, well, what we find when we look historically is that central banks tend to lag in their cuts. In other words, they don't start cutting until they're pretty certain that their economies are in recession. Now, nevertheless, and then when they do cut, they cut much more than what the market's priced in or what forecasters are expecting. Now, nevertheless, there's a handful of cycles historically, where central banks have managed to cut without an impending recession. In those quote soft landing cutting cycles, on average, the central banks tend to be cutting about 200 basis points. So that's in the first year after the cuts start. So that's about twice the pace than what's currently in the SEP, for example, than what Federal Reserve officials expect. Overall, when we take a look at it, we think it's a reasonable baseline to think that probably the Fed is going to be a little bit more delayed than what the markets are currently pricing. But again, nevertheless, when they do start cutting, they'll probably be a little bit more aggressive, than maybe what they're forecasting. But when we look at, what the bond market is currently pricing, we're pretty much priced for a soft landing outcome. And that's the case, when we look at equity, we think that's the case when we look at equity valuations or riskier, credit, lower quality credit as well. So to us, when we think about longer term valuation of the bond market, it still looks good relative to your risky alternatives. Even though, from a near term tactical trading perspective, we could see, some of those cuts getting priced out. Of course, the path from here to there is never a straight one. It'll probably continue to be bumpy.
Yeah, I think that's the building consensus, which is trim your risk, bumpy ride ahead. Tiffany stays with us, Tiffany Wilding from PIMCO on her calls, Navigating Descent. Let's turn our attention to tech. It could be a year of descent in tech. Who knows? The Consumer Electronics Show is kicking off in Las Vegas, where the latest and the greatest in AI tech promises to dazzle. Ed Ludlow is on site. He and Caroline Hyde, I'm sure, will dazzle. Ed, good to see you. So NVIDIA just keeps giving and giving this munificence. They're now going to help me. They're going to help me with an AI chip for my PC. But set the stage for us. Good morning, good afternoon.
Yeah, I mean, this is NVIDIA's original competence. Good morning to you, Manis. I think the stock hit a fresh record Monday, a gain of 6% amid a broad rally in semiconductors. But the catalyst was their CES news. 3 new graphics chips for PC that allow for on-device running of large language models, generative AI tools. And NVIDIA's argument has been that if you have the most superior chip in your PC running it locally, you have a greater security benefit versus running a large language model over the internet. And even though there was that broad rally, there's certainly evidence that the announcements they made at CES, where it's AI everything, certainly helped the stocks that fresh record, although I believe we pulled back a little now. There's also a really strong automotive presence here in Las Vegas. There is every year automotive technology. The piece of news out this Tuesday morning is Mobileye, the maker of chips for advanced driver assistance technology, is expanding a relationship with India's Mahindra, where it will put ADAS technology into Mahindra's next-gen cars. That's important because of the scale and size of India's market. Consumers there have been reluctant to buy higher cost premium cars, but it is the world's most dangerous set of roads, both in terms of death, collision, injury, and the dollar cost to insurers where accidents take place. I'm told by sources that this is a binding deal and it will be revenue generating. And I bring that up because you remember last week, Mobileye dropped the most on record, Jan 4th, because it gave a sales outlook for the year significantly below Wall Street estimates, where they expect sales in this current first quarter to drop 50% year on year. Why? All of their customers and the automakers that buy their chips and systems built up a backlog or inventories, so they've stopped ordering to work through them. But apart from that, here at CES, it's all about the weird and wonderful. We do expect the funky devices, and I'll keep you posted on what I look at.
Okay, Ed, thank you so much. I'm sure you'll bring those to us, and I'm looking forward to all the content from CES. Coming up, Capitol Hill, they're getting back to work.
House Republicans don't want an omnibus spending bill, so we have the January 19th date and the February 2nd date that we have to contend with, even if we have those spending levels. So that's the mission before us right now, and time is of the essence.
The House returning from recess, gearing up for a battle over the spending package. That conversation next on Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern. We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing. Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
We are exactly where we were in June. The Freedom Caucus voted before Christmas, Kaylee, to accept the Fiscal Responsibility Act spending levels. So I'm a little frustrated to hear that news today. What Speaker Johnson has before him with these levels is how will these spending bills come to the House floor? House Republicans don't want an omnibus spending bill, so we have the January 19th date and the February 2nd date that we have to contend with, even if we have those spending levels. So that's the mission before us right now, and time is of the essence.
Republican Congressman French Hill weighing in on the DC spending showdown, racing to a head as Congress grapples to avert a partial government shutdown. Now, both parties are using January 19 as the deadline to pressure their prerogatives. Ukraine aid for President Biden, tighter immigration policy for the GOP. Kaylee Lyons is tracking all of this. Kaylee, here we are. Will there be a stumble before they come to an agreement? I mean, are tensions mounting, or are we coalescing towards a deal?
Well, there very well could be a stumble, Manus. In theory, the top-line deal that was reached over the weekend was a good step forward, but as we were just hearing from Congressman French Hill, there are many conservatives who are not happy with that deal, would have liked to see deeper spending cuts or border policy measures included in this, which speaks to the idea that this still could hit hiccups in the 10 days between now and January 19th, where 4 different appropriation bills need to be passed in the House, the Senate, and signed into law by President Biden. The issue here is, A, that there could be conservative policy riders attached to these bills in the House to pacify some of those farther right members of the House Republican Conference on the part of Speaker Mike Johnson. Plus, you still have to divvy up that $1.6 trillion into each appropriation bill, decide how the money is going to be spent, and that work can be very difficult to do in such a short legislative span of time. 4 different appropriations bills needs to get over the finish line by January 19th to avoid a shutdown of those programs. The other difficulty here is whether or not a continuing resolution might be needed. That is something, a short-term kicking the can down the road that Mike Johnson has pledged not to do again. If he does so, that could get him into trouble. It could also get him into trouble if he were to pass appropriations bills with significant Democratic support with content that conservative members of the House don't approve of. That could bring him basically to the same fate as former Speaker Kevin McCarthy, who of course lost his job late last year over passing funding-related bills with Democratic support. So that's the tricky line to walk here, in addition to border security measures that House Republicans are really pushing for, many of them saying H.R. 2, border security, or shut the government down, Manus.
Okay. Kaylee, thank you very much. Kaylee Lyons there with the very latest on the debt ceiling negotiations. Tiffany Wilding is still with us. When we talk about U.S. debt, we've gone through a number of asphyxiating moments last year, credit reviews, ratings reviews. You talk about 15-year yields at a 15-year high, create an array of opportunities. But what is the fiscal risk here? Is that one of the imminent risks on the cards, or is that something that I look at in 3 years, 5 years? Do I just kick it into the long grass for the U.S.?
Yeah, well, I mean, obviously, I think that, understanding the point in time where the bond market really starts to get worried about, longer-term fiscal sustainability issues is obviously very difficult to forecast in any given year. Now what we would say is that the types of numbers, that Congress, is looking to pass for this year's government spending levels, will basically keep spending levels, a little bit higher than last year, on a nominal basis, but not that much. So, overall, we think actually government spending in terms of its impact on the economy for this year, for 2024, will be much more muted, than some of the more, kind of the stimulative trends that happened last year. But nevertheless, the path of U.S. deficits that are projected as a result of demographics and some of the, the Medicaid, Medicare, the non-discretionary programs, that path obviously is unsustainable. And when we look to the election that's coming up, for example, this year, the likely candidates for, either a Biden or Trump, neither of those candidates, in terms of what they're telling us, are really going to change that longer-term trajectory. So of course that's something that Congress and the government is going to have to deal with at some point. When the bond market decides to really push them on that, obviously is uncertain. But as a result, we like to maintain positions in our portfolio for a steeper interest rate curve. We think when investors look to increase duration, move out of cash, we think there's enough to do it in the intermediate sector, not go all the way out to the long end.
Okay, keep it in the short end and look for a re-steepening on the curve. Again, another consensus narrative that is building from the various bond guests. Tiffany, thank you so much. Tiffany Wilding there from PIMCO. Coming up on the show, market moving events that you need to watch on New Trader's Diary, right here on Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Trading diary, what you need to watch for the rest of the week. Wednesday, Fed speak. New York Fed President John Williams hits the tape, and it's the deadline for the SEC to vote on. You got it, that spot Bitcoin ETF. Please let it pass. And the next Republican presidential debate. Let's see what color comes from that. Thursday, you got it, inflation prints CPI and another round of jobless claims. We round out the week on Friday. It is big bank earnings on Wall Street ahead of the opening bell. This was Countdown to the Market Open. John Farrell will be back. We have it on good authority. Not sure when. He will be back. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Equities, they are turning lower today. We've got the S&P off by about 0.5%. Coming up, we're going to be checking with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, to get his sense of where this Federal Reserve is going to go. Then Callie Cox, investment analyst at eToro, we're going to get her macro call that's coming up. Jill Blanchard, President of Enterprise Client Solutions at Advantage. We're going to talk about the retail outlook and the health of the U.S. consumer. But first, let's kick this thing off with Mr. John Tucker.
All right, let's start you off with this Bloomberg Business Flash being brought to you by Interactive Brokers. IBKR's Redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit ibkr.com. S&P 500 extending this year's losses. Tech shares under pressure after Samsung posted its sixth straight quarter of declining operating profit. Yep, Juniper Networks, the leading stock in the S&P 500. Hewlett-Packard Enterprise on the other side of the screen, the biggest laggard, as HPE in advance talks to buy Juniper Networks. That's according to the Journal. There's a disconnect, meantime, between market pricing for Fed cuts and what policymakers have been saying, and that's going to lead to market choppiness, according to Amanda Agati at PNC Asset Management.
We don't think that first cut is going to come as early as what the market is expecting. We do expect the Fed to pivot. We think it'll probably be 3 cuts, likely in the summer or second half of the year.
And right now in the S&P 500, you have 10 of the 11 major industry groups. They are lower. S&P 500 overall down 25 points. That's a decline of 0.5%. We're at 4738. The Dow Jones Industrial Average down 273 points, and the Nasdaq 100 right now 96 points lower. That is down about 0.6%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Lisa and Paul. Is that Lisa Mateo over there?
It is. Thank you, John Tucker.
We got you for the next 3 hours.
Yes.
So good stuff. We'll have a good time and we'll plow through it. Got a lot of good topics to talk about. We got Lisa Mateo, we got Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So you can head over to youtube.com and search Bloomberg Radio. As John was just reporting, we got some red on the screen here, a little bit of selling out there, but there are definitely some stock-specific stories out there to cover. So let's check in with Carmen Reineke. She covers all the equity markets for us at Bloomberg. She joins us here in our Bloomberg studio in New York City. Carmen, what are you looking at?
Yeah, so the first thing I'm looking at this morning is JetBlue. Obviously, airlines have been really top of mind for everyone after the Alaska Air incident, but JetBlue shares are actually down about 6.8, almost 7% today after a Bank of America downgrade to underperform, citing a difficult domestic environment for airlines, and also saying that there's potential further execution risk as we wait for a ruling on the lawsuit with the Department of Justice regarding its purchase of Spirit Airlines. The analyst also lowered their price target on JetBlue, that's ticker JBLU, to $3, which is about tied with one of the lowest price targets on the street, according to Bloomberg data. So not looking very good for JetBlue. Obviously, the entire airline sector is still looking pretty red today. They also had, their chief executive officer, Robin Hayes, will step down next month. They'll be replaced by Joanna Garrity, a 20-year JetBlue veteran. And a great thing to point out here, she's the first woman CEO of JetBlue and the first woman to lead a major U.S. air carrier. So kind of an interesting little tidbit there.
Yeah, interesting. I'm looking at Matt Miller's favorite function is the COMP. Okay. You put in there for any security, gives it kind of the last 5 years performance or whatever time frame you want. So this is set for 5 years. Over the last 5 years, JetBlue has had a compounded annual return of negative 20.7% per year. You compare that to the small cap index, which is up about 9%, and the industrial index, which is up about 14%. So really dramatic underperformer there.
Yeah,
I've never
yeah.
flown JetBlue.
I'm always on JetBlue. Oh, are you? I do. My kids like because they have the TV screens in the seats. See, they're fans of that. They don't like doing it on the little phone. But what's interesting here is that he's been kind of this disruptor in the industry. Like he's kind of known for that, especially when it had into that bidding war for Spirit with Frontier. Yep. Like he was really a big part of that. So this will be interesting, the switch.
Yeah, exactly. And also just the timing of this, I mean, with everything else that's going on, it is definitely interesting. In other news, also looking at Match shares, that's ticker MTCH. They are up about 6% today after a report that activist investor Elliott Management has built a roughly $1 billion stake in the company. So Match obviously owns dating apps, including Tinder and Hinge. And this whole sector has just really gotten a beating over the last year. Shares of Match were down about 12% last year. Bumble, also in the industry, 30%.
Are you one of these swiper people?
Oh my God! Unfortunately,
That's
yes.
your generation, right? That's your generation.
It's what you have to do. Nobody goes out anymore.
Well, you just go to a bar. That's how you do it.
That's how we used to do it.
Nobody talks to people at bars. And I'm
What's that?
good at talking to people, but no one talks to people at bars anymore.
That's true.
But I tell you, I'm an avid reader of the New York Times wedding section. It's changed over the years, but it's now like 90% of the people met on a dating app.
Yeah. Well, and what's interesting here is that they're so prolific, and yet these companies have had a really hard time translating that into profits, right? And we've seen Match, offer new paid subscriptions for a few of its different apps. But those haven't really taken off, right? There's still, I think, a kind of like a long story here that we'll see. And Elliott Management has a pretty good track record of lifting share prices of the companies it's involved with.
Yeah, absolutely. So, I mean, Match used to be, that was part of Barry Diller's thing way back in the day, but look at Match again over the last 5 years. Compounded annual return for Match equities, negative 24% per year.
And these are not cheap, these dating apps. I mean, they can get into the hundreds of dollars depending on what you pick and what option you want.
Well, the Tinder one was $500, I think, a month.
That's crazy.
500 a month.
Yes,
that's
I'm
like
telling you,
the
Paul
highest
Sweeney.
tier, newest, yeah.
And people do that?
I don't know anyone personally, but someone must.
All right, give me one more. I can stay on this Match thing.
Yeah, so the last one that I'm looking at today is Hewlett-Packard Juniper Networks.
That's right.
So Juniper Networks, top performer in the S&P, up more than 22% after a report that the company is in advanced talks to be bought by Hewlett-Packard Enterprise for about $13 billion. Shares of Hewlett-Packard are down about 8% on this news. It seems like analysts are saying that it might be a better deal for Juniper than for Hewlett-Packard. But at the same time, I mean, you were saying earlier, Juniper makes like the stuff that makes the internet work, right? It's routers, switches, and it also has corporate wireless networking gear, and it has a lot of customers, including Amazon, Microsoft, Alphabet's Google, and it's also like a tie into the AI play, I think, for Hewlett-Packard.
All right. I mean, John Tucker's got an AI angle to him. I mean, everybody's playing the AI thing to get a little bump in the multiple.
I'm bringing back pets.com.
Pets.com, exactly.
Pets AI.
Pets AI, very good.
Sure
That'll work. All right, Carmen, thank you so much. That's great stuff. Carmen Reineke, she covers all the equities for Bloomberg News. Let's head down to the Princeton, New Jersey compound of Bloomberg Intelligence, because we're going to talk to Ira Jersey. And I want to talk to Ira about, he covers all the interest rate stuff for Bloomberg Intelligence. He's our go-to guy there. Hey, Ira, I'm looking at the 10-year, spot on 4% right here. It feels like that's kind of where it should be. Where do you think we're going to end up at the end of 2024 in terms of that 10-year?
Yeah, so our model says 3.96 right now.
Whoa.
So yeah, pretty darn close to where we are. So year end, we're still looking for a pretty decent rally, but I don't think it's going to be a straight line to get there, Paul. So our view is that we're going to wind up seeing somewhat better data than maybe what the market's expecting, and that will wind up putting into doubt some of the early interest rate cuts by the Fed, and that will therefore push yields across the curve at least a little bit higher before. But I think that will be a pretty interesting opportunity for investors, because we do think by year end we're going to wind up seeing 10-year yields down toward 3.25%. So a nice 75 basis point rally from where we are right now.
Now, Harry, you mentioned Fed cuts. So when do you think the first interest rate cuts will hit in 2024? We're hearing some are saying March. Do you think they could even move higher at some point?
Well, I don't think that. I think we're done hiking at this point. I think a lot of the economic data that we're seeing, and including the ISM employment report last Friday, that gives me a little bit of pause and has me rethinking some of my medium-term thesis. But I think that some of the early cuts that are being priced in March and May are probably a little bit too optimistic on people who want cuts. But I do think at some point the Fed's going to cut, maybe with the first cut in the second half of this year. So we're looking at more. So September's off the table because of the election, but basically my view is that if they don't cut come July, they're going to wait till November, but then they'll probably have to cut more quickly, right? So if they don't cut until November, maybe at November they cut 50 basis points and then another 50 basis points in December. So you can wind up with pretty deep cuts by year end regardless. It's just a matter of the path of how we get there.
So Ira, when you talk to institutional investor clients today, what are they doing in the Treasury market today? I mean, I know last year, I'm sure some of your clients were shorting Treasuries. We heard that from a lot of the hedge funds. Warren Buffett's of the world and mutual funds of the world were buying Treasuries so that you had your bid, your buy, and your sellers out there. What are they doing today?
Yeah, so they're pretty neutral when you look at things like the JP Morgan does a weekly survey of Treasury sentiment with both active and all investors, and that's actually pretty neutral right now. So, and I think that's probably the people that I've been talking to, they're more or less like, okay, we're market weight. We want to kind of sit on our hands a little bit here because we're not sure of the direction. But most investors are leaning long, right? They know at some point they want to be buyers of Treasuries. But people who were getting short at 4.5% and then got whipsawed in the sell-off and then re-rally last year, I think are a little bit reluctant to take a lot of duration risk going into the year. And then people who are long, they had a pretty good end of the year. Look, the Bloomberg, the Bloomberg Treasury Index was actually up last year. Where if you had said in October, hey, we're going to have a positive return for the year, everyone would have laughed at you because we were down 10%. We had a 10% rally in basically 2.5 months, and after that kind of volatility and sweating and staying up at night, you might think about just sitting on your hands a little bit, not taking a whole lot of interest rate risk, and that's where I think a lot of investors are right now.
Hey, I got to ask you about this article that I saw. Bill Gross, the former bond king, he posted on X that the 10-year Treasury is, quote, overvalued with a yield of 4%. But he also said that the 10-year Treasury inflation-protected yield at 1.80% is the better choice. So what are your thoughts on that?
Yeah. So I agree with Bill. I wonder if he's been reading our research on the Bloomberg terminal, because that's been our view actually since November. So I think firstly, tactically, I agree with the idea that maybe 10-year yields are a little bit higher. I do think that some of the data will come in a little bit better than the market's currently expecting, and that will cause interest rates and yields to go up a little bit in the 10-year. But I think longer term, 10-year yields, like I mentioned, with going back to 3.25, means that at some point, 10-year yields are more fairly valued. On the TIPS story, I do think that that's one of the things that's most mispriced in the rates market right now is our TIPS inflation break-evens, because when you look at when you look at inflation break-evens at 2.25%, it seems very likely to me that we're going to have inflation at least a little bit higher than that over the next couple of years, and because of that, TIPS might be the better alternative as opposed to nominal treasuries, just because you can take advantage, get 1.8%, and on top of that, whatever inflation is. So especially if you think that inflation is going to be higher than 2.25% over some period of time, TIPS might not be bad for your portfolio. But again, that's everyone has to make their own decision as to whether or not they want to take that risk, because the other risk is in TIPS is that if you get inflation lower than 2%, say, then you can meaningfully underperform treasuries.
Hey, Ira, smart people like you and Lisa Abramowitz tell me I got to pay attention to these treasury auctions. You know what? I don't. But I rely on your research here. But if I were to pay attention to some treasury auctions, which ones are upcoming, and any of them important?
Yeah, so we have the second reopening of 10s and 30s of the 10-year note and the 30-year bond tomorrow and Thursday. Those are the important ones. Today's a 3-year note auction. I think it'll come and go and not be that meaningful. But we've seen some auctions that have gone off well and other auctions that have gone pretty poorly. And I think that there's a growing number of auctions that have seen somewhat weaker demand than the market was expecting come auction close. And I think that that's maybe a sign, and some people are taking that as a sign that that the high supply and the amount of debt that's being issued to fund deficits is overwhelming some of the demand. And I think in some segments that's true. I don't think that we're there quite yet. But we'll, as we price in more and more interest rate cuts, you'll see demand be okay at those auctions. But if the data comes in better, the refunding auctions in February could be really interesting. So remember, the end of this month, we have the Treasury. The Treasury will tell us what it expects to issue in February, March, and April. And if you remember last August, Paul, we had a lot of volatility once they made that announcement. So that'll be on a lot of investors' minds.
Harry, you touched upon this a little bit. If now is the time for fixed income, what hurdles do you see out there?
Well, I think I don't know if there's a whole lot of hurdles. I think one is if now is the time for fixed income, yes, that's probably somewhat true, but it's more that it's a time for fixed income versus, say, cash. So if you believe that the Federal Reserve is going to cut interest rates 6 or 7 times over the next 12 months, then being longer duration, being in a term instrument, even a 3-year note, could wind up being a better long-term investment than being in cash. So if that is your view, then it is the time for fixed income. Versus something like risk assets or equity markets. I'm not as sure that might be the case, because presumably, just on a valuation basis, if rates go down, if the Fed cuts interest rates, then risk assets often do reasonably well in that environment.
Real quickly, Ira, 30 seconds. How's the liquidity in the marketplace? I mean, if I come with a big block of treasuries I need to get out of quick, can I make a phone call or two and get it done on the street?
Yeah, you can. You're going to pay up for it. So the bid offer is certainly somewhat wider. It's a little bit better now than it was in December. In December, you had window dressing going on amid, year-end kind of pressures, and you had dealers that didn't want to necessarily warehouse a lot of risk. That's eased a little bit this week. Once we get toward the Fed meeting at the end of the month, you've definitely seen people lighten up on some of their risk profile. So liquidity's been okay, but it's okay only considering, say the last 2 years. It's not, and in the forever history of Treasury, it's still not particularly good.
Yeah, not back in my days at Solomon Brothers. You could bring any trade to us, I don't care who you are, and we get that trade done. I think those days are probably gone here. So anyway, Ira Jersey, thank you so much. We appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. S&P 500, that's off 0.4%. The NASDAQ also off 0.4%. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Alaska Airlines and United Airlines say they found loose door bolts on Boeing 737 MAX 9 jets that were grounded because of a fuselage blowout on a flight last week. Bloomberg's Katrina Nicholas reports.
For carriers to return these jets back into service, they have to do full inspections, obviously, of the bolts, the fasteners on both the right and the left-hand sides of these mid-cabin aft doors. And that is going to take some time. United has said that it's probably going to take 5 technicians working for several hours on each jet. Boeing has said, well, fortunately, the types of bolts that have been questioned with the Alaska Airlines incident are only found on that MAX 9 jet, not on the other family of MAX jets.
Thanks, Katrina. Shares of Boeing are down more than 1%. Microsoft's investment in OpenAI faces a possible investigation from EU regulators. Bloomberg's Samuel Stolzen explains why the partnership is under scrutiny.
What the European Commission really want to examine is Microsoft's level of control over OpenAI and whether or not these investments that it's made, a report suggesting up to $13 billion for a 49% stake into the company, whether those investments constitute a relevant merger situation and therefore constitute effectively something akin to a form of takeover.
Bloomberg's Samuel Stolten reporting from Brussels. And Amazon is rolling out a new video streaming feature that rivals Apple's AirPlay. The feature, called Mattercasting, will make it easier for iOS and Android phones to send video to Amazon devices. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. As we look at the S&P 500 right now, 10 of the 11 major industry groups are lower. Biggest drag, that's coming from energy. The only group that's in the green right now that belongs to healthcare. Samsung Electronics profit warning dragging on the technology sector after yesterday's boost. They had fourth quarter operating profit that could fall 35%. They're looking at weak consumer demand for smartphones, and that's hitting sales of memory chips. Meantime, investors awaiting inflation data. That's the consumer price index. We're going to get that on Thursday. And also earnings results later in the week. With the financials, they will start the reporting season. That is on Friday. Right now, the S&P 500, 18 points lower. That is down 0.4%, 47.45 in the index. The Dow Jones Industrial Average down 228 points. The Nasdaq 158 points lower. That is down about 0.4% right now. The 10-year yield did breach below 4% right now at 4%. That is down 2 basis points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Lisa and Paul.
All right, John Tucker, thank you so much. We appreciate that. Lisa Mateo is here with me this morning with Paul Sweeney. We are in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Well, a lot of folks, I think, were taken by surprise, Lisa, that last kind of couple of months of 2023 when stocks ripped, yields pulled back dramatically as treasuries rallied. Kind of took a lot of people by surprise. Some people were saying maybe it pulled some of the performance from 2024 into that last couple of months of 23. But let's check with somebody who does this stuff for a living, Callie Cox. She joins us. She's an investment analyst at eToro. She joins us via Zoom. So, Callie, what do you make of what we saw there in the fourth quarter in 23 and kind of how that might have changed your outlook for 24?
Well, I look at the fundamentals, Paul. Of course, you say I do this for a living. I'm an analyst. I look at the underlying. So, the fourth quarter didn't really change my opinion on the economy that much because the economic data didn't really change. We got more indications of a soft landing. Of course, markets took that in stride. It's one of the reasons we saw such a strong rally in the stock market. But going into 2024, we're reminding people that it's not unusual to see a heat check in markets after markets rally 15% in 2 months. So the price action may be different than what we're seeing in the underlying economic data. We're just reminding people of that.
Now, I got to talk Bitcoin and crypto because that's huge right now. I mean, you have all these Bitcoin ETF hopefuls. They're waiting for this green light from the SEC. What's your take on the crypto market?
Well, right now, of course, Bitcoin is around 45K or so. Quite honestly, I haven't checked it this morning. But Bitcoin's rallied a lot since the grayscale decision that we got at the end of August. It seems like a lot of this Bitcoin ETF excitement, at least for now, could be priced in. But I say that knowing that there's a short-term view and a long-term view, right? A lot of this excitement could be priced in, but long-term, this opens the door for a new wave of investors into Bitcoin. And we think, especially after the details we got yesterday, we think the product is compelling enough for people to take advantage of it. So that could keep a floor under prices, Lisa, and it could even help boost the price in the long run. It just depends on what we see from close.
So, Callie, as we think about 2024 here, one of the issues is I kind of feel like earnings have to really come through, particularly after the run we had in the last couple months of last year. And I'm looking at the S&P 500. It looks like analysts have about a 12% growth rate in earnings in 2024. A, do you think that's a reasonable number? B, is there risk in that number? Is there upside to that number? How do you think about earnings?
Yeah, Paul, if you ask me what the most confusing part of the market landscape is right now, I'd say earnings as well, because you're right. I mean, earnings growth does look promising this year, but at the same time, it's not the kind of earnings growth that you would like. And what I mean by that is it's earnings growth driven by cost cutting instead of sales growth, which is inferior when you think about the fact that many people associate higher profit with higher sales. So as an analyst, I think about that. It's not the best we can get, but right now in an environment where, people are still dealing with a lot of economic uncertainty, it might be enough to keep stocks buoyed. And right now, I know everybody says, watch the guidance every quarter. Right now, I think guidance is especially important because we got that sea change from the Fed in the fourth quarter, and corporate C-suites are taking that into account when they're planning out the next year.
Hey, Callie, we have some major financial firms releasing earnings this week. You got J.P. Morgan, Bank of America, Citi, Wells Fargo, BNY Mellon, the list goes on. What are you advising your clients when it comes to bank stocks?
Well, banks, of course, are one of the bellwethers of the economy, Lisa, and they're down about 15% from the highs right now. So they're not, when you say the stock market is nearing all-time highs, you're not talking about banks. And this matters right now because there's a lot of dispersion between sectors. And quite frankly, the fact that banks in a lot of cyclical sectors are well below their highs makes them attractive if you believe the economy can stand sturdy this year. One thing I found interesting, we do this survey of retail investors every quarter. It's a survey of global investors. I look at the U.S. investor cut, and retail investors are getting bullish on banks. We ask a question that says, what sectors do you own and what sectors do you want to add to? And financials were the most owned sector, and they were one of the top 3 sectors in our last survey that investors said that they wanted to add to. So people see value in banks right now, especially as the economic data remains encouraging. And, I don't think that's such a bad stance.
So, Callie, I mean, Lisa was long all the Magnificent Seven stocks, so she's laughing all the way to the bank. I, unfortunately, was not. So should I be chasing some of those names this year, or should I maybe go to find some value somewhere else, maybe some of the names that did not participate?
Well, first of all, good for you, Lisa. Wow, that's awesome. You love your quality risk. Heading into this year, I think it's an environment where you still have to stay nimble. We're advising rotating into cyclicals, taking small steps into them, because we still don't know if a recession is, a serious risk right now. Economic data has stayed sturdy, but there's a lot of pressure on the economy at the moment. So, as you head into 2024, dip your toes in small caps, dip your toes in other sectors, more cyclically rate-sensitive sectors, but hold on to that quality risk because we still don't know if we're out of the woods yet.
And how would you describe today's market environment? I mean, what are your clients telling you? What's the sentiment? What are their feelings?
Oh, well, retail investors remain optimistic, but with a hint of skepticism. And I say that knowing that a lot of retail investors have rotated into cash recently. And that to me tells me that there is some, positioning around economic uncertainty, positioning around a recession that could be coming. And we all know the vibes are fraught, right? Confidence is increasing, but there's still, this palpable nervousness within markets and, among investors, even though sentiment has picked up over the last 3 months or so. That's encouraging to me. I mean, you want a market that's filled with healthy skepticism instead of exuberance. But at the same time, that could limit markets in the short term, especially as people digest this January wave of economic data we're getting.
Hey, Callie, for the first time in a couple of years, fixed income investors actually made some money in 2023 thanks to that rally towards the end of the year. What are you advising your clients to do in the fixed income space here? Because, I can buy a 2-year treasury with my federal government and get 4.3%. That's not too bad.
It's not too bad, and it's one of the best yields that you've been able to get on short-term bonds or short-term treasuries, for that matter, in over a decade. So, bonds look attractive here. When I talk about bonds, I mean more conservative treasury allocations type of bonds. Corporate bonds are a separate discussion, but if you're worried about a recession, treasuries are the classic sanity hedge. The Fed is looking to cut rates this year. If we see more weakness in the economy, we could see more rate cuts priced into the market and on the back of that. So if you're worried about a recession, now is the time to hedge it. And treasuries, time and time again, have been a strong recession hedge.
And one of the things you said in your notes that stood out to me was, remember that even healthy markets go up and down. Just a little reminder there, huh?
Well, yeah, and it's surprising to me how many people forget that. I think you really have to keep your emotions in check in this environment too. Because yes, again, the vibes are fraught and stocks are near record highs. That doesn't make for an easy environment to be an investor in. But you really have to first understand your goals, of course. If you're a long-term investor, many pullbacks are buying opportunities for you based on history. But at the same time, understand the fact that the fundamentals matter, especially now as markets eye a soft landing. So don't get too caught up in the headlines, unless you're a trader. And of course, you have to pay attention to those.
And Callie, we're still, just a couple of percent away from the all-time high on the S&P 500. Do you have valuation concerns here, or what is your sense of valuation in this market here?
Well, valuations, I think it's a different discussion if you're looking at the broad market versus the sectors. So broad market, yes, valuations are quite high, but a lot of that is driven by tech, consumer discretionary, and more of the growth sectors that we saw do well last year. So heading into 2024, I would say look at valuations on a sector basis. Don't get too caught up in them. I think it can be a trap to look at valuation versus history, especially considering all the progress that we've made in tech since the 2010s. But right now, it's a great time to look for value. Value last week outperformed growth by the most since, I believe, July, in 6 months. So, look at value, especially in the cyclical part of the market, and consider the fact that valuations don't look the same across the board.
All right, Callie, thanks so much for joining us. Callie Cox, investment analyst for eToro, which is a platform for retail investors. A lot of young investors are on that platform, so cool to check in with Callie, former Bloomberg staffer here. S&P 500 off 0.5%. Same for NASDAQ. The Russell's off 1.3%. Again, so the small cappers underperforming a little bit. Looking at the yield curve, again, the 10-year Treasury smack on 4%, off almost 3 basis points today, sitting right at 4%. WTI crude oil up about 1.25%. WTI is just under $72 a barrel. Looking at Bitcoin as we wait that SEC ruling, it's off about 0.7%, 46,800 for Bitcoin. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. Donald Trump is taking his presidential immunity claims to a federal appeals court in Washington. He is fighting election interference charges from special counsel Jack Smith over his actions on January 6th. More on this now from Bloomberg's Jody Schneider in D.C.
His lawyers basically are going to be sparring with federal prosecutors in this battle to determine if the former president is immune from charges of trying to overturn the 2020 election because he was president at the time.
Now, Bloomberg's Jody Schneider in Washington. That hearing is going on right now. A ruling in favor of Trump would be a fatal blow to the Justice Department's efforts to try him. While either side has the right to appeal, neither the full D.C. Circuit nor the U.S. Supreme Court would be required to take the case, so this court's ruling could be the final word on the matter. The probe into last week's fuselage blowout on a Boeing 737 MAX 9 is honing in on 4 bolts that came loose, bolts that investigators have not been able to locate. Bloomberg opinion columnist Brooke Sutherland says the investigation is putting new attention on Boeing's fuselage manufacturer, Spirit Aerosystems.
There's a lot of scrutiny over the relationship between Boeing and Spirit Aerosystems. This used to be a part of Boeing until back in 2005. Executives decided they could boost their profit margins by focusing on design and outsourcing some of the actual manufacturing work. But this was really just a set of factories. This was never really meant to be an independent business.
Bloomberg opinion columnist Brooke Sutherland. The Department of Labor is set to release a final rule that would make it harder for companies to classify workers as independent contractors. Major gig economy players like Uber and Lyft are following this very closely. The rule, which is expected to come down today, would change how the Department of Labor determines whether a worker is an employee or an independent contractor. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. And with this Bloomberg Business Flash, the S&P 500 extending this year's losses. Tech shares under pressure after Samsung posted its sixth straight quarter of declining operating profit. And then you have Juniper Network shares. They are rallying after a report that Hewlett-Packard Enterprise is in advanced talks to buy the business. Meantime, Emily Rowland at John Hancock Investment Management isn't so sure investors can expect a lot from technology stocks this year.
So tech stocks were up about 58% last year on about 5% earnings growth. Now, don't get me wrong, 5% earnings growth was of the best globally in the U.S. tech sector, but I think it makes sense for tech to potentially take a bit of a breather here. We're not downgrading it.
Investors have some Fed speak to consider today. Michael Barr, the central bank's vice chair for supervision, is taking part in a discussion at noon. Some of the individual shares on the move. Match Group, the owner of Tinder and other dating platforms, that's rising after a Wall Street Journal report said the Elliott Investment Management Company has built a stake of about $1 billion in the company. S&P 500 right now, 19 points higher. That's up 0.4%. We're at 47.43 on the index. The Dow Jones Industrial Average, 256 points lower. And the NASDAQ 100 right now, 61 points lower. That is down about 0.4%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. And that's your Bloomberg Business Flash. Lisa and Paul.
John Tucker, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're also streaming live on YouTube, so you can catch us there. Go to youtube.com and search Bloomberg Radio. Let's talk about the consumer here. I think the consumer is pretty solid out there. I mean, unemployment rates, historic lows. Everybody's got a job who wants them. Looks like the stimulus money is kind of played out. Drawing down on savings, now racking up some consumer credit. But by and large, the consumer seems to be in pretty good place right here. Let's see if that's translating into retail sales. Jill Blanchard, she joins us, president of Enterprise Client Solutions at Advantage Solutions. Jill, thanks so much for joining us again. I'd love for you to just kind of recap for us here in mid-January how the holiday sales season kind of wrapped up for some of the bigger retailers you talked to.
That's great. Thanks, Paul and Lisa. Glad to be back, and thanks for having me. So, holiday 2023, there are some conflicting reports out there. One of the things that we did see, though, is a disproportionate amount of spend in the 2 to 3 days that are leading up to the holidays. So last month, we talked about Thanksgiving. We saw that then. We also saw that at Christmas this year, too. So it could be that consumers are waiting to see what sort of money they have left to spend or waiting for a big sale. But it definitely has an implication on how retailers and manufacturers plan their promotions and inventory. So I think that we can expect this to continue in 2024. Think Super Bowl, Valentine's Day, Easter, all coming our way.
Yesterday, we saw some good news. Lululemon, Abercrombie, American Eagle, they all raised their sales outlooks because of what you're talking about, that strong holiday season. Now, what do you think about this fast fashion trend? We've been hearing a lot about Shein, Temu. I mean, what's that going to look like into 2024? Are they going to start taking over a bit?
I think one of the big trends that we can expect to see in 2024 is a bigger emphasis on value. And value means different things to different consumers, right? So it could be buying a used luxury car instead of a new luxury car. It could be buying a private brand product instead of a name brand product. It could be shopping at Costco and Sam's for a better price for the larger size. And so really key is for retailers to understand what sort of value their consumers are looking for and meeting them there. I will say specifically as we talk about things like a Lululemon, there's also a heavier lean into smaller and more affordable indulgences, which could be what that trend means. So maybe not taking a vacation, but indulging in more indulgent clothes, let's say.
See, I'm the exact opposite. I'm in a stage in my life I'm getting rid of stuff, and I spent the last several years getting rid of stuff, but I'll spend money on a vacation, but maybe that's just me. The consumer packaged goods companies, they were pretty darn good over the last several years during those inflationary period in raising prices. Where are we in their ability to do that now? Has that played out? Are they starting to see some challenges to their margins?
most of that has played out. We are in the midst of doing our new survey where we're going to get a better read as to whether or not we're going to see any price increases or decreases in 2024. But most of them have already played out. They're really more focused on promotions and pricing and getting that right. So think about this new trend of this disproportionate spend before the holidays. Retailers and manufacturers go to great lengths to make sure that they have the products priced at the right price at the right time. And so with this surge on those 2 to 3 days, they're really going to need to do some different thinking as to how they want to promote products to ensure that they're at the right price to get sold, but they're also not subsidizing existing sales. Also, inventory. They've got to make sure that it's available. 27% of the time that a consumer can't find the product they want and they buy a different product, they stay with that different product. So it's pretty key to be on shelf.
And let's dig into where consumers are going to be shopping. Are they going to the mall? Are they going online? Are they going on social media? TikTok is saying they're going to put a lot of money into this. Where are they shopping?
That really is as well. One of the big things that we'll see in 2024 are shifts, right? So shifts in the what. I talked about like the trade down in category, the affordable indulgences. Where is another shift? And so we saw big emphasis on more discount retailers in 2023. I think that's going to take off in 2024. And the how. We did see great success with mobile shopping during the 2023 holiday season, indicating that it's easier for consumers to use that as a medium. So definitely we'll see big shifts in the where and the how. Overall, the volume at the top level might be the same, but the shifts in the what, the where, and the how could be big.
How about luxury here? That's a big area for Lisa. I'm more just kind of the Dollar General kind of guy, the Walmart guy. Where's luxury spending these days? Because I know a big part of luxury has historically been the Chinese buyer, but the Chinese economy obviously is weaker than I think people anticipated at the beginning of 23. So how's the overall luxury space looking?
I'll go back to one of the things that I've been talking to our clients about, and that is luxury means different things to different people. And so there are products that will be luxury to certain consumers if they're trading, up to, call it a mainstream brand versus luxury to somebody else. They're trading up to a brand that you can't get in store and maybe only online, and then to another level. So luxury really plays out in different ways for different consumers. What really is playing out similarly, though, across the consumer groups is an opt-in to more affordable luxuries, which again could be something like a used luxury car versus a new luxury car.
And what about buy now, pay later? I mean, that was big during the holiday season. That's the reason a lot of people were able to buy so much during the holidays. Will that continue into 2024?
Yeah, there are a lot of eyes on the first quarter of this year for that reason, as well as a potential pantry load. There were so many discounts and deep discounts in the fourth quarter of last year that there's the potential that consumers, really leaned in heavily to those deep discounts and now have to use that product up through the first quarter. So there are a lot of eyes on first quarter as to what the impact could be from debt, credit card debt, as well as pantry loading.
Joe, where are we in terms of the store footprint in this country? I know for the longest time, maybe 10 plus years, the industry's kind of been downsizing its footprint. Is the industry right-sized right now?
Is the industry right-sized? We definitely have seen a slow in store growth over the past 2 years, largely due to the effects of COVID and the focus having to be on supply and pricing. And so we do see retailers now getting back to the old focus of store growth. And so I think that we'll see a resurgence of store growth, but not to the level that it used to be.
All right, Joe, thanks so much for joining us. Appreciate it as always. Jill Blanchard, President of Enterprise Client Solutions at Advantage Solutions, talking about the retailer. I mean, it seems like near us, Lisa, in New Jersey, the Short Hills Mall was packed to the gills every day during the entire month of December.
Yeah, even during holidays, though. I went there during the holidays, did a little shopping, and it was pretty packed.
Yeah.
But it has started to change a little bit. But that's what I was wondering. Are shoppers going to the malls? Are they going online? But it's the social media thing that really gets me. How many people are shopping on social media?
Yeah, it's interesting. And, what we learned, I guess, over the last I don't know, 6, 7, 8, 9 years is omni-channel, having the store, having the online presence, maybe, buying online, picking up at the store, all that kind of stuff. So that omni-channel is something that has really worked well for a lot of the retailers. S&P 500 off about 0.4%. The NASDAQ just about the same. Yields, look at the 10-year Treasury yielding 4.0% on your 10-year Treasury. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, they found the door that blew off of a Boeing 737 MAX 9 jet, but investigators have yet to locate 4 bolts that were supposed to secure it. Meanwhile, officials at Alaska Airlines and United say they've discovered loose bolts on MAX 9s grounded by the FAA. Bloomberg's Charlotte Ryan has more.
But the fact that we've already seen this in other planes in the fleet does beg the question of what is going to happen next. The actual inspections that these airlines have to carry out don't take very long. It's about 4 to 8 hours per plane. And again, in that best case scenario, that could only take a few days. But what the question now is what the regulator is going to do as a result of this. Will we see a broader grounding?
That's Bloomberg's Charlotte Ryan reporting. Shares of Juniper Networks soar above 22% following a Wall Street Journal report of a possible takeover. Bloomberg's Kriti Gupta has more.
The report here that there are in acquisition discussions with HP Enterprise. That's HPE, not the HPC that we traditionally think of when we think of HP. Remember, those are 2 different stocks here. Nevertheless, a pretty big number. HPE might be acquiring Juniper for about $13 billion. Of course, skyrocketed the company to a record high, basically pricing at a market value of about $9.6 billion.
Bloomberg's Kriti Gupta reporting. And Elliott Investment Management is making an investment in love. The Wall Street Journal reports it's built a roughly $1 billion position in the Match Group, the owner of Match, Tinder, Hinge, and other dating platforms. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up after this.